we go.
Hey, welcome.
Another Bought a Farm podcast, episode, I don't know, 3, 4? 4. Episode 4 of I Bought a Farm.
4. Yeah. So anyways, we were talking. So I've got this, I haven't shaved with a razor.
We started this, I said, Jared's mustache game is looking pretty strong recently.
Which I appreciated. And so now we're continuing.
It's not porn stash, but it's like, it's approaching.
We're getting there.
It's approaching Dirty Sanchez probably.
Yeah. Okay. So I went to, I haven't shaved with a razor for years, just because it's like it irritates me and like
razor and shaving cream. Do you use an electric razor?
It's not even a razor; it's like a trimmer.
Oh yeah,
yeah. So like my barber uses a little edge trimmer, and I was like, that thing works pretty good. And so she sent me a link, and I'm on it.
Yep,
been using that for years, and over the years I've dropped it a few times, and like it's kind of seen better days. One of the edges is like totally broke off, so I have exposed blade like going like this. So. Yeah, a little bit of bleeding.
Might nick a jugular.
So yesterday, I got halfway through the shave, and I was like, "This is not working. Like this is bad. I'm gonna end up looking like the Grinch, on Christmas." And so I went and grabbed my wife's like razor out. I don't know what she uses it for, but out of the shower and like some of her slimy shave gel or whatever. Yeah. So I got the rest of it with a real razor. So
sometimes it's good.
Yeah, I did mine. It was like, man, it's so silky smooth.
I did. I use a trimmer as well, and I shaved off. I had quite a thick beard going there, and like I instantly felt like a cool rush to my face.
It felt really nice.
What?
Like a baby's bottom.
A little breathable side on that. So yeah,
I did keep the stash though, and so when I shaved everything else but kept the stash, I was like, what is this hair all over my upper lip? It's so long yet so thin and stringy.
Yeah. It'll fill in.
Oh yeah, I'm happy with it.
Get a little just for men to like.
No.
Darken her up.
Keep it all natural.
Oh, natural.
Get enough hair in the back.
You think that? You think that increases your sales approach for real estate?
Oh, I know it does.
Yeah.
Just my attractability as a person.
Yeah, I mean, I would say for the older folks, you remind me of like a '70s used car salesman at this point, with the hair and the stash.
'70s for sure. I was gonna say more of a roller skate rink professional.
Oh yeah. Yeah, like roller
/
hockey.
land salesman.
Like roller hockey type stuff.
Yeah. For
roller
sure.
derby.
For sure, I should be in Miracle. Yeah, that's what we're trying to pinpoint there. Canadian.
Oh, you were going more Canadian hockey player.
'70s Canadian hockey player.
I was going more like Dazed and Confused. Like I graduated high school and then I'm just kind of hanging out.
Yeah,
with the high school kids still.
Same look.
Okay. Yeah. What in the
know what I like about high school chicks, man? I keep getting older. They stay the same age.
All right. All right. Well, we've got and I bought a farm for you today.
Seth Vander Weide is our guest name today.
Yep. And so Seth is an enrolled agent, which is a tax profession.
Yep.
So he's not a licensed CPA. He's not a tax lawyer, but as an enrolled agent, he is a tax professional with a variety of things that we're going to get into today, including self-directed IRAs, 1031 exchanges. Talks about tax benefits with owning land.
Maybe some group buying power. Seth owns several tracts of land across southern Iowa with multiple different groups of people. He's involved in farming practices in which, he's not hands-on with it, but it is some type of a business strategy that he's applying to like roughly 1,600 acres that they oversee there. And so he's got all kind of interesting stuff going on that we're going to learn from today.
I think what will be interesting about Seth is not only is in his professional duties, is he kind of living in this world, he is applying it personally himself as a passionate outdoorsman and somebody who's interested in land ownership and land management. And so when you bring those two together, these are the type of people we're looking for to learn from and to kind of understand better and really to be a sponge with to say, like, how can we do this stuff? And hopefully that's what everybody listening to this kind of comes into play.
It came up briefly before the podcast, so you'll have to be sure to throw this out to him. He bought a piece of ground from a guy last year that it's like 183 acres roughly in southern Iowa.
Yep.
And the sellers, one of his stipulations is I'd like to hunt opening day of shotgun with my daughter for the last time. And he's like, yeah, that's fine. Guy shot a booner. They shot a booner off of it that day, so I could tell he was a little better on it.
Yeah. That's a big stipulation.
Yeah, that's a big stipulation. So
maybe it's like you can hunt, but here are the deer you can shoot type of thing.
Yeah, I think maybe in hindsight that's what he's thinking. But.
Interesting. Is he in southern Iowa?
Northwestern.
Okay, but that's where he's buying.
Northwestern Iowa, and as we were talking a little before the podcast, he said like land values up there are off the charts
Really?
for farming. Yeah, it's all ag.
Yep.
It's great soil
in
up
northwestern
there.
Iowa.
He said an 80-acre tract just north of him sold for $25,500 an acre.
Oh my God.
Yeah, I said, well, sorry, what?
Well, and so this will be an interesting conversation we get in with Seth, because where we're buying, the majority of the places that we're buying, cash renting, and it's almost irrelevant. Like, it's so low that it's like, okay, I could rent out this 10-acre, tillable ground to a farmer for what, $500 a year? Like, that's stupid.
Yeah.
Whereas where they're at, they're getting $200+ an acre for 100 acres a year.
I think in our part, we were just looking at that index the other day.
Yep.
I think in our part of Pennsylvania, it's like 55 to 65 an acre on average. A little further west. So my parents get 75 an acre.
Mm-hmm. Down where my farm is, it's like 52, 53.
And you're more timber, hilly country.
Yep. Yeah. So I get it. It makes sense if you have 200 acres and you're getting $50 an acre. Like, it's $10,000. Great.
Yeah. Land values around here are going to be way more tied to
timber value
for sure, but also our proximity to just metropolitan areas where people
for
are.
outdoorsmen. Mm-hmm. Mm-hmm. Well, let's bring Seth in and get this conversation rolling.
How's it going, guys?
Good morning, brother. Appreciate you coming on, Seth. And Jared was kind of giving me some insight. So, I guess before we get into this, we kind of introduce you as an enrolled agent. Just give the listeners a little bit of understanding of kind of what that entails, or what your kind of daily duties as a professional look like.
Yeah, sure. So an enrolled agent with the IRS basically is it's an accreditation for people who are tax professionals that are not CPAs.
Okay.
So what that means actually is I cannot audit financial statements. I cannot make opinions on people's financial statements. I cannot go and audit a government. I can't go audit a nonprofit business. However, I can do anything with taxes that a CPA basically can do. I can represent you in front of the IRS the same way a CPA can. Cannot represent you in front of a tax court actually, but neither can a CPA. A tax attorney can do that. I can't. So
Gotcha.
When it comes to income taxes, have a lot of similarities with the CPA as far as income taxes go. They have far more responsibility on the financial reporting, financial statement side. So what that looks like in my day-to-day business is, during tax season, I usually meet with 8 to 10 people a day via Zoom, via in-house. People drop stuff off. Just doing tax preparation, basically.
Yep.
During tax season, just doing tax preparation. The rest of the year for me, what that looks like is, we do some bookkeeping for some clients and payroll for some clients. More so than that, we do a lot of estate planning, business succession planning, things like that. We're heavy into ag up here in our neck of the woods in Iowa. So we do a lot of tax planning for the year and multiple year tax planning, and that's kind of what we do in general, basically. Yeah. So,
well, and today is Tuesday, April 19th. So unless you filed an extension, your taxes better be in.
They should be in, yes, or at least paid.
Yeah, exactly. Well, Seth, one thing that's interesting to Jared and I is the fact that, not only on a professional level are you kind of working in this arena a lot, but as a kind of a personal, investment and passion yourself, you're really applying a lot of the things that you do on a professional level every day. And so I guess, one of the things we're curious is maybe give us a little background on some of the personal or call it even your business side, the properties that you're investing in and where those are. And I guess maybe if you can classify those a little bit of like, why you're invested in certain properties per se.
Sure. So obviously our first property that we owned, my business partner and I, was our office building that we have here, which I'm sitting in right now. We own that together. So that's just for business purpose.
Yep.
We always talked about finding other types of properties to own. And we have actually owned one other 5-plex before, and we sold that because we the rental business is for the birds, man.
No, I know it, man. Well, you say that, and it's funny because one of my properties is where we're sitting in is a building that I own. that I run a business out of, and I've got a leasee upstairs essentially in this building. And it's funny because even when Jared and I go back through and we talk about the properties we own, like I almost always forget about this property, this building and this acreage that it's on, because I don't relate it to when we talk about, real estate and property that I own.
Yeah. So basically we'd always talked about, obviously we see lots of clients and we're like, oh, who's successful? What types of properties are they investing in? How are they generating wealth? And we all have to do it at our own pace and time, because we all make different amounts of money and have different life backgrounds. So it just, what are things that we're looking at to do? And, the first thing that caught our attention, I think, was, we deal so heavily in ag that we thought, well, it would be a good idea for us to be owning some farmland and trying to find someone to custom farm some land for us, so we can learn and be better at our craft as accountants. Mm-hmm. That's kind of where our first idea came from. So we bought, I think we started looking probably 9-10 years ago, really pretty green behind the ears of what to do and what to look for in land, so I know you guys are licensed real estate professionals. I reached out to, I have a real estate agent that I work with all the time, and, it's kind of just told them what we're looking for, just what we're trying to get into. So I don't even know what year it was, but we bought like 64 acres, I think it was, and 40 of that was tillable. Okay. And we just kind of started with that basically. And we started with that. And on a personal side, I always wanted to own hunting land because I am a bow hunter. So sure. I throughout the years, I've had, I've knocked on doors, I've had permissions from people, I've leased ground, I've hunted public, I've done it all. And I was just at that point, at that same time, I was like, I'm kind of tired of knocking on doors. I'm kind of tired of leasing ground, because the leased ground weren't really producing what we had hoped. And the public ground was really, there's tremendous public ground in Iowa, mm-hmm. but it just seemed like you're always fighting with people for spots, so yeah. Then it kind of stemmed from there. For me personally, was always looking for my own way to find a way into buying my own personal property for hunting. So when you looked at that first piece, Seth, and was that you and your business partner that kind of went in and bought that together? We did, yes. Okay. So that was me and my business partner. Yes. Yep. And that was more of an agricultural property. Okay. And so when you're looking at that property, and you said it had 40 some acres of tillable, what in your mind, and again, knowing you're green behind the ears then, but kind of fast forward to what you know now, what were you looking at that made that attractive? Was it the 40 acres of tillable and the potential cash rent off of that? Or what in your mind and your business partner's mind were you saying, this looks like a good property for us to purchase? We were pretty slow in our first purchase. Okay. So we had been looking and looking and looking. We kind of knew the price in the area fairly well. We were looking. Mm-hmm. And so we thought it was a good buy. It wasn't overvalued. It wasn't undervalued. We just thought it was a solid, good buy. And we looked at the soils, basically. We ended up learning a lot about the soil itself and what's going to produce a good crop. So generically in Iowa, you can look at the CSR2 rating, which is the corn suitability rating. Okay. And it had a pretty solid CSR2 rate. And we thought it had a fairly good price. Attached to the property with a pretty good CSR2 rating. Mm-hmm. And it was a very flat river bottom ground. So we knew it would be a good producing ag farm.
Got it. And that was your purpose for the purchase initially, right, Seth? Was you guys were wanting to buy a piece of property to farm, to one, understand your client's approach better, and two, to have some hunting ground, for you guys personally? Yeah. Yep. I mean, yes. Number one was we really wanted to what does this stuff mean we hear every year in our tax appointments? Right. Yep. What does this actually mean? We understand it. You can tell me all about it, but what better way to do it than learn, yep. And just go through it yourself. And 100%. We lost money the first year farming. What do you
Yeah. Well, and I think that's what's interesting about it, Seth, is because, Jared and I are kind of in the same position where, we whether it's just because of our passion and trying to self-educate or whatever it is, we kind of understand what we want out of a property and how to get into it, and we can make projections, we can, make spreadsheets or write it down or do whatever. But ultimately, there's only so much stuff that you can predict or expect, I guess, in a lot of cases, especially where you're green. In our case, it may not be farmland as much as it is timber value. And so you're kind of going at it and saying, well, here's what I think the timber's worth. But until that, forestry consultants on the property and marking trees and giving you an actual, estimate of what the standing timber looks like, it truly is just a ballpark estimate of what you think or what you know.
Well, and like Jed told us, and I imagine that agriculture is in somewhat of the same boat. It's very much tied to timing.
Yep.
Timber obviously is growing over the course of years and years and years. In agriculture is from year to year, but there still is a timing element to say, certain types of crops or certain trees are going to be more valuable. And so, like you said, that can be tough to pinpoint as you're looking at purchasing a property. Yep. You kind of have to make your best guess.
And so, Seth, did you buy that through, let's call it traditional real estate buying? Like, it wasn't an auction, you used an agent, it was listed, you bought it that kind of way?
That's correct. We used it through the traditional agent, but yes, that's correct. Yes.
It's actually interesting to hear that property wasn't put up for auction. It seems like that would be kind of common practice in your area.
So in our area where I live, it's a very common practice.
Yep.
I mean, auction basically is the only game in town up here by where I live, but
Yep.
we're also 3 hours away from where we live and where we own our ground. So
Gotcha.
Down there, they're using more of the traditional real estate method through real estate agents. So,
okay.
Which I find to be, if I could recommend up here to people, I know you guys are doing this, so this will be a little plug for you guys. I think it's way more advantageous to use a real estate agent than going through the auction process. I think the auction process doesn't give you enough time to actually get the listing done properly and get the word out, which I think there's a true benefit to having a real estate agent involved. I really do. I've seen it up here, down there, when the real estate agents get involved. It just gives you more time for people who can afford and want that from further areas to come in, and it gives you more buyers or sellers to the auction or to the property, basicly. So
I would agree. As a buyer, I think you want to, you've got a lot of advantage actually using a real estate agent. And in some cases in a lot of cases as a seller too, but especially like in farm ground, especially, up in your neck of the woods, northwestern Iowa, especially if, it's owned by a farm, a corporation, an LLC that's wanting to 1031 exchange, which we're going to get into at some point, and they need a definite sale date to roll some of that stuff over. I think that's one of the biggest advantages is to know that this property will sell, on this day. And hopefully you've done the marketing to promote that properly. But
and the two big things I think you see, especially in farm ground, is number one, I think a lot of that stuff changes hands, real estate lawyer to real estate lawyer, person to person, prior to it ever being on market or even being in an auction. And then when it gets to auction, typically it's people that are surrounding and neighbors that are trying to, compete against each other for that farm.
I think the percentage is high in terms of how frequently does a neighbor end up buying a neighboring piece of farm ground. And almost all of them know about it beforehand.
For sure.
But the way to expose, and Joe Gislick is the one I think that exposed this for us. That's when we hit kind of our aha moment. Is the way to reveal the true market price of what that property will tolerate is to actually bring it to market. Whether it's at auction or via private.
Yeah. Well, and I think what's interesting about it, and so Seth, do you still have that piece of ground?
No.
You've sold it since then?
Yes.
In a traditional format, real estate agent?
Yes.
So I guess I'd be interested to hear and tie this into my question is, as a real estate investor, right? Which is what the three of us kind of are looking at here is that we probably buy some properties that it's our forever
accomplished
property.
In progress aspire.
Yeah, right.
We're in all three phases here.
I'm looking at it as like there is an end goal price in my head that I hope to get for my Ohio farm, let's say in 5 years, 6 years, 7 years, whatever, or the amount of revenue I get from it. That may not necessarily be market value at that time. It could be below market value. So I guess the interesting thing there is like, at what point do you embrace the market to say, hey, I want to get as much as this market is going to potentially give me for this farm versus like, this is, if I can get this X, like I'm happy because that's what I projected I wanted out of it anyways.
You're asking what's the right time to sell?
Mm-hmm.
It's $1 million question, isn't it?
Yeah, right.
Yeah.
Well, I guess, what did you feel like with yours?
Yeah. So for us, we had, in the meantime, so we purchased that land, and I'll just give you how we thought about this first one.
Sure.
We had bought that land, and another smaller farm came up about 4 miles away from there. So we decided to buy that probably 3 months after that.
Mm-hmm.
And we were tickled pink to have both of those. And we were tickled pink to have both. And we were going to probably be done for a few years buying land. Well, next thing you know, like, a piece of property comes for sale. Like, man, that's really, like, it's been on the market a couple times. It was pretty cheap. And I was like, boy, I think we can make money in ours because, land's appreciated pretty quickly over a year.
Yep. At
that time frame. And I'm like, boy, we can get enough down, I think, to purchase this new property. And it was really cool for me because there was probably 50% timber on that one.
Mm-hmm.
My business partner, who is not a hunter, could care less about that, who doesn't understand the value of recreational ground, was a little bit more hesitant on that. And I said, don't worry, like, we're going to double our acres. So if inflation still happens, like, we're going to have almost double the acres now. So if inflation happens, no matter, or when inflation happens and the appreciation that goes along with that, we're going to have more acres for us that are going to inflate. So I go, at the end of the day, more acres is going to be a better thing than less acres. So that was kind of our mindset at that time, was like, let's just get more acres.
Got it.
So,
and
we did it. We sold the one.
Okay.
And we held it just for a little over a year.
Yep.
And we decided we were just going to pay tax on that one.
Okay.
The other one we did do a 1031 exchange on. So. Okay.
And so I was going to say, before you purchased that second piece of property, you sold the first one?
They owned the first two.
You owned them together?
We owned them together, yes.
Okay.
Yes.
And did you use cash on the second one, or did you leverage any equity from the first one?
We leveraged the equity from the first one, yep.
Okay.
And in all this, I guess, when we first did this, we used our office building as leverage, basically. The equity you had in our office building to purchase the second property.
Interesting.
Basically. So we used our current property. When then we bought the first one, then for the second one, we used our building as collateral, basically.
So how does that work then, Seth? That's like essentially like a home equity line of credit, but on your commercial business?
We just basically rolled out our
I hear you see Jeremy's getting some ideas over here.
We rolled out we redid our office loan. We had probably only 6 years left on it. We had a ton of equity in it, and we borrowed, at a pretty cheap interest rate at the time. We borrowed up to like 75%. I think the bank was going to not let us do the full 80%. They did something like 70% or something in that. I don't remember. It's been a few years back now. So we just took out the loan, used that for the down payment, and it all cash flowed yet. So nothing really changed the same for us. So, because we had quite a bit of equity in our office building. So.
Interesting.
Seth, can I ask who you guys are financing through? What bank do you use?
We use a local bank up in our hometown. Yeah.
See, and I think I was going to say, that's the advantage of where you're at, Seth. And like a lot of those local banks understand the value of raw land, farmland, agricultural, tillable land.
They're just used to dealing with
where
it.
We're at, they don't.
Not so much.
So we're using more farm credit unions, things like that.
Yeah, USDA loans or more rural just or nationally serving companies. Yeah, a lot of these local guys are more, just residential commercial loans. Like I said, we're southwestern Pennsylvania. We've got a lot more people, and we do have timber, but a lot less, farm ground.
I was going to ask that because we didn't touch on that, Seth. Did either of these parcels have a structure on them or no?
Our first two, none of them had structures.
No structures on them. Okay.
Yeah.
Cool. So, all right. So you've got these two pieces. You eventually sell the first one.
Can I backtrack real quick? You guys developed a new LLC, I assume.
We used an existing one that we already had owned our office building in.
I was going to say, because if you rolled that, essentially you were going to have to use that LLC to own the property, correct?
That's correct. Yep. That's correct.
And
so we used our current setup that we had, which, Yeah, we had done it. Yeah, so my business partner and I, he's the majority shareholder. I'm the minority shareholder, and our land is owned the exact same percentage as our accounting practice, basically. So
Okay.
Got it.
So that just means you get to hunt for cheaper.
yes.
So, all right.
Yes.
So let me leverage the tax professional in that. So you buy that piece of ground, obviously under the same LLC. You're able to justify that essentially because you work with a lot of farming type clients. So if you're buying that land essentially to, let's say, learn that practice, is that kind of how the business goes hand in hand?
Yeah, I mean, yeah, and our so it's not owned as our, I should probably back up a little bit. Our entity, we're set up as an LLC, filed as a partnership for
Yep.
that, and we basically are holding all of our real estate assets in that LLC.
Yep.
Our accounting practice is owned by its own
Gotcha.
corporation.
Okay. That makes
this
sense.
is not inside. I would never recommend that to anybody. Worst thing you could do would be own land inside of some sort of corporation or a business or any type of business that you are active in, your active trader business, what you do.
I gotcha. So you
it's a holdings company that owns the building you're sitting in, not the business that operates there.
No.
Right.
Yeah, I should have clarified that right away.
No, that's fine.
So,
and that's for liability purposes, right?
Absolutely. Yeah. So especially when it comes to, you do not want to have any of your personal assets, any of your personal wealth if you are self-employed in your business.
Yep.
You want to keep that totally separate.
Because what's the risk there, Seth? Somebody's out there farming one of your pieces of ground that you own, they get hurt, and they're looking for damages from your accounting business.
That's correct. Yeah. Yes. Now all of a sudden our accounting practice is liable.
Cool.
Yeah. And there's a lot of risk there for our accounting practice, for
that's
something
important.
that's not related to it.
That's important. That's a really important thing to mention.
And the reason I say that is because that's one of the things that I've started to look at a little bit closer on my end, because technically this building is in the same corporation as my active marketing firm.
Yep.
In retrospect,
risk,
I'd rather have this building not in that same
100%.
LLC. But it is.
Dude, I wonder how many new business owners mess that up initially. It's tough to get out of because you have to pay a transfer tax of 1%, 1.5%.
Yeah.
Usually, of the value of the property, I think.
Yep, of the value of the property.
Not cool.
To move that.
Not cool.
Well, and so that's to
ultimately save yourself, maybe a bunch of money, so it might be worth it depending on your situation.
And that's where I'm venturing into this year. So I have, like Seth, I have a LLC set up that is where all my real estate assets are, my investment farms, Kentucky, Ohio. My plan is that I'd like to investigate or at least look at moving my building into that same portfolio away from, the rest of the stuff. But, and again, it's there's equity in the building. So you want to, and that's where I was trying to get with Seth here is like, you start to leverage this equity, right? People get so hung up and maybe nobody thinks to themselves, well, like I just want to own one farm. Like I can't even fathom owning multiple farms or doing this. When we talk about wealth, and I think we talked about this a couple of weeks ago, most people wealth is on paper, right? It's not cash in the bank. It's assets of ownership. And, I talked to a guy the other day who owns a farm, and actually it was yesterday. And he said, well, like I'm thinking about buying this other farm. Do you think I should just sell this one and buy that? Or do you think I could roll equity over? And I'm like, well, how much equity? He had like $140,000 in equity in his first farm. I'm like, use your equity, man. Like that's what that's there for. Yeah. And I think people get so hung up on like, well, where am I going to get another 20% cash to put down or something? That's a lot of money when we're talking about some of these farms. Meanwhile, you've got way more than that in equity in an existing asset.
Well, so that solves the down payment aspect of that. But isn't the real question at that point, can you afford to make both payments?
Well, yeah. I mean, obviously you can't outpunt the coverage there.
Yeah.
You have to have a fund that is going to be able to pay the mortgage. Now, Seth, I was going to ask you on yours, when you did your equity on the business, that then become a single mortgage?
No, we had two mortgages. We had a mortgage on our building.
Yeah.
We had a mortgage on our farmland.
Okay, there you go.
Yeah.
So, I've heard it in both cases. I've heard sometimes, especially adjacent pieces, they'll form you a single mortgage.
Yeah.
Other times you'll have separate mortgages, even though it's the same.
A blanket mortgage is what that's called.
Yep. Or you'll have separate mortgages just because it can be with the same bank, but it's just, maybe different states or something like that.
I do think that's an important point, though, because a lot of conversations that we have about, like, can I use equity to roll this in? Can I afford? It's a two-tiered question. And Seth, feel free, if it's more than that, feel free to tell me. But you have to make the down payment, which a lot of people, like you said,
that's the most scary thing for people. And I encourage people, and Seth, as a tax professional, you may tell me I'm crazy. If you're comfortable with your financial situation, I tell people a lot of times to look at even your personal home, your primary residence, and the equity that you have in that. Now, you can't risk your primary home, but for a lot of us, the one thing that we do have asset equity in is our primary home.
And a lot of, frankly, these less educated, I shouldn't say educated, less, lenders that are less familiar with recreational land investments will lean towards, well, I can't give you a loan on that necessarily, but I can give you a home equity line of credit. They're more familiar.
Or refinance completely and take X amount over what you owe for a cash check.
I agree 100%. I mean, I think there's some advantage there for taking stuff out of your home or taking equity out of your home, applying it for a down payment. That's what makes investing in land interesting is the amount of leverage that you can do. You got to get started. You know, once you get started and you get equity built up in your land, it becomes easier. And maybe you just want one piece. It kind of depends on everybody's situation, what they want. But, I think the first place to start is if you have a business asset like we did, second thing is your home. I did both of those things. So, I mean, I'd be lying to say I didn't do those things. So, I mean, I did both of those things for myself personally. So,
yeah. And I think it's something, if you've got a spouse, you're definitely going to have this conversation because they're going to get nervous when you say, well, here's what we're going to do. We have $100,000 in equity on our personal home, right? Our primary residence. We're going to take that and we're going to invest it into this farm. But if you bought your house in whatever the mid 2000s, you may be paying 5.25% on your interest rate, whereas most recently you can get it under 3 in some cases. So you're better to refinance your home, take out X dollars that you may need for a down payment, and you're still maybe even paying less per month than you were because you refinance the interest rate. So I think that's a big one for people to understand. The other thing that I think is interesting is if you buy your first farm, and let's say you do have to put down the traditional 20%, think about how much equity you immediately have in that farm. That maybe you're not ready, to your point, to afford and buy something 2 months from now, but a year from now or 2 years from now, you have been making payments into that. Yes, there's a good chunk that goes to interest, but you are still making some towards the principal plus your down payment. You have a chunk of equity that you can leverage now to buy another farm, or buy an adjacent piece.
In a couple of weeks, and Seth, you can obviously feel free to speak on any of this, but in a couple of weeks, we're going to have some ladies in from which lending institution?
Rural First.
From Rural First, yes. And they're obviously very well versed in this type of lending. And I think we're going to literally ask them every question that I know that I have and some of our listeners have as well, as terms as literally when I refinance this asset, how does that affect my current mortgage? What does that mean for my interest rates? How much can I actually take, and what does it mean to take and apply that? Because like you said, Seth, until you're actually in and doing it, for somebody like myself, it can be kind of like, I'm not exactly sure how this all works. It's kind of overwhelming.
Here's the thing. Here's a tip that I usually give some of my clients to do. If they're thinking about buying, it may not be farmland. It may just be like, hey, we're thinking about buying a new pickup or a camper or whatever you're thinking about buying. Here's just a good financial tip, I think, is that, do you have enough money to pay for it? No, we're going to finance for it. Do you have enough money down for it? No, we're going to finance the whole thing. I said, okay, so here, before you go ahead and do this, why don't you go ahead, do you know what the payment's going to be? Usually know what the payment's going to be.
Yeah.
Call it $1,000 a month.
Yep.
I said, okay, so can you right now, instead of buying it right now, if you have some time, why don't you go for 3-4 months, maybe even 6 months, save $1,000 every month? Because you're not going to have that if you buy this. If you can't save $1,000 in your current budget right now, you can't afford this. If you can save $1,000 and it's not a big deal for the rest of your living expense that you need for you and your family, great. So now that might be a little bit too small of an amount, or not quite the same analogy for farmland. But if that's something that you're thinking about and you're going to be short on the payment because you're not going to have income on it, you don't have enough to pay for it, save that money. If you're thinking about this, just try to go a year with saving what your payment's going to be.
Yep.
And do you need that money to live?
Yep.
And if you can do that, you can afford it.
Well, and ultimately, you know, this is one of these things where it's to me anyways, it's kind of abstract. We're like on a bell curve. I don't know exactly where the line is at, but it seems like if your intention is to, if there's an investment that we're talking about, so in our case, let's say it is a piece of farm ground or hunting ground, you know, I want to buy this 100 acres. If you're financing 100% of it or 90 or even 80% of it, it's, the less money you're able to put down, the less likely you are to ever be profitable on that asset, right? Because your interest rate is going to be increased. Your equity initially is going to be less. You're
playing on either the appreciation, if you're taking timber off to make money and revenue on that, you know, the improvements that you're going to make that are going to enhance the value of that property. You're really banking, and you got to be confident in that, because if you run the numbers and you're way off, I mean, I won't say that you can't lose money, because you probably can in some cases, but it's probably rare, right? Yeah. It's a very stable investment. It's a really stable security to have from an asset standpoint.
Well, and use like a home as an example. Maybe, you know, Seth, you've probably been involved in some of these, but like, you know, I think that, you know, I'm guilty of it. I think people have thought like, oh, I'm going to put 20% down on my house and, you know, I'm paying this interest rate. And then they think when they sell it for $30,000 more than they bought it for, that they're like making a profit. And I think in a lot of cases, it's like, no. All you paid was interest for the, you know, the first 10 or 15 years.
Yeah. Well, and I think that's where, and I'll give you my personal situation on that. So I bought my first house when I was, 27, 26, something like that. You know, I forget what it was, 170,000, something like that. Bought that house, I think I got a first time home buyer, so it was like 5% down, right? Low. Had to pay that PMI, which sucks, right? It's an extra $100 or whatever on mortgage a month. Anyways, you get to a point where you've paid that thing down, plus there's some appreciation. I sold the house for like 190 something. If I looked at the numbers, was I profitable on it? Probably not. I probably broke even. But I lived in that house
on a sticker.
But I lived on that house for 5 years, essentially for free at that point then, since I broke even. So that money then, although I didn't necessarily make money, I now have a little bit bigger pot to then put on the next house, right? And so I think that what you have to be careful with and again, that's primary residence, right? So it doesn't matter as much.
Right.
From an investment standpoint, if you're thinking like this is a 5-year plan or a 7-year plan, you have to be pretty confident with what revenue coming in. And this is what I was going to ask Seth. When you talk about your LLC setup there on those properties, and this goes back to your monthly payments, I know at least personally, like I have a bank account, and it doesn't need to be numbers necessarily, Seth, but you know, I have X amount of dollars in that bank account, which is what I withdraw for my mortgages, what I withdraw for my utilities, because I have structures on them. I'm doing an HVAC system on one. It'll come out of that. With you and your business partner, Seth, do you guys do like an annual cash infusion into that account? I guess how do you have a fund to pay the monthlies and things that Jared was talking about?
Sure, that's a great question. In that situation, our company actually pays a rent to us.
There you go.
For the building.
Yep.
So I mean,
I do that as well.
We get a rent from it. That rent is more than what our mortgage is now. So
cool.
We take the excess money to help pay for our shortfall on the farmland.
Got
basically.
It. Very cool. So, and is there any other income producing happening on those two properties, or were there when you had them?
On those properties, we rented the one for 1 year, we farmed them for 1 year, and then there was some CRP on it. Yes.
Okay. So you did have a little bit of revenue coming in.
Yep.
Yeah. So right. I think that's to your point, and really, Seth, kind of what you said about saving that 6 months, you know, what I've tried to do, and some of it is, you know, I might get a dividend at the end of a year from a business or something. You know, I'm putting an investment in, and eventually I hope that fund is somewhat sustainable, right? You need some sort of revenue happening every year, or, you know, I do a big timber harvest and I drop a lump sum in there or something like that to sustain that bank account. Otherwise, I'm going to have to put a cash infusion, whether it's my business or me personally, every year to pay that stuff.
Yeah, no, that's a great question. I think personal residence and business location are easy ones to answer, because it's like, I personally pay for my own residence out of money that I'm paid in a salary or dividends from my business.
Yep.
a business location is fairly straightforward, whether the business owns the location, it's obviously an asset, or they rent, in which case, it's an expense.
But there's an operational business making income to pay for it.
Yep. So I think, as it relates to your question, my tangent on that is or extension of that is these properties that are owned by an entity that may not be producing enough income, a holding company, for instance, to pay for those mortgages. How do you supply that company with the funds to pay those mortgages? Where does that come from?
Seth answered one, which is like if you've got a business to pay rent to that entity.
So, and that ties back to your comment earlier. You're asking about, are these similar businesses? Is it because we take clients out, or because it's relative to our in Seth's case, accounting business that you can do that?
Where's the line on the tax end?
Well, things? So like let's say, for instance, you own a restaurant that has no relevancy to hunting land. In what case, if any, can you justify a transfer of funds from a business like that into these holding companies? And if not, how do you personally transform those funds to be able to be used for it in a tax preface that makes sense?
Yeah, that makes sense. So basically, so it depends on your structure, how you're set up for some, in your restaurant situation. Are you set up as a corporation? Are you set up as a partnership? Or is it a sole proprietor?
Let's say LLC, taxed as an S corp, which is pretty popular around here.
Which is very common, and then that's a good practice. You should be set up that way.
Yep.
As far as your business goes. So what you can do basically is at the end of the year, you're going to draw. If you have profits, you're going to draw the dividend out.
Yeah.
That dividend then, it should be used probably to hopefully pay your taxes. That means you've been profitable.
Right.
And then the remaining portion is yours free and clear to use. And that's what you should be funding your other investments with. And your other investments being, if it's land, if it's stocks, whatever you decide to invest in should be funded with that.
And that
in our
fundamentally,
case, the three of us sounds like land.
Yeah. And that fundamentally would give you a cash basis then.
Yes.
Yeah, 100%. Yep. So the answer there is take a tax-free dividend from your business. And so I'm curious your opinion on this, Seth. We've heard from multiple CPAs that Jeremy and I have worked with, like a percentage of or a guideline for how much tax-free dividend you can actually take
as an S corp when you have salaries being pulled.
As an S corp compared to the salary that you're paying yourself as an owner.
Yeah, so that's a really good question. That's a hard question.
Because the IRS defines this as a reasonable salary, correct?
And it is reasonable. So then it comes down to, all right, so this is a loaded question. So I'm just going to leave this. I'm going to leave this right here as a loaded question. But so it kind of depends on what industry you're in, right? Yeah. So if you're in a personal service industry like myself, where most of the revenue that we generate in our office is done from our personal services, the IRS is probably going to make you take a higher wage out.
Yeah.
Because it's your time and effort. Now, if you're in a more manufacturing type, or for us, ag type business where you have such high cost of equipment purchase, you're just with the amount of revenue or with the amount of assets you have to produce that, you're allowed to take out a smaller wage just because you have it's so much more capital intensive basically at that point.
Yeah.
So is there a percentage? I say that a lot to people, you should be paying out a dividend every year. Yeah. And I think every industry is probably a touch different.
Yeah. And there is a salary threshold. At one point it was like 132 or 134 or something like that now, to where if you hit that number, I don't know what the proper term is, but they're more insensitive to the dividends you take than thereafter. Yeah.
So that's not really how the law basically is going to state more.
That's not really how it works.
So
the law is just going to, what's reasonable.
Yeah.
And, I think you can go on LinkedIn, you can go on any of these sites, and you can type in the area where you live, and you can see what people with your experience are getting paid, the low end, the middle, and the high end. And I think as long as you're not you don't want to be probably at the extreme on the high end.
Yeah. Right.
Just because you're just going to be paying too much Social Security and Medicare tax in. Unless you already max it out, then it doesn't matter.
We're just really trying
that's what I was saying. There is a max out number.
Well, we just really like helping the Biden administration. Yeah, that's something we're...
That's why they were...
We love paying taxes.
Yeah.
Yeah, well, yeah. Sometimes it's just inevitable,
Well, so I think to answer your question, and there are strategic advantages to certain businesses per,
Sure.
you know, what Seth is saying, and even myself, and where, you know, I own a business in hunting and fishing marketing, right? That I could lease a property to go and shoot photo and video on with Colton. And that is a justified expense from this business and a justifiable income to this other business.
Yeah.
I would agree with that. Yeah. You guys have a much better case than I have.
Yeah.
You know, I'm not in a hunting business. You know, the only thing I could do is, you know, if I wanted to, you know, if we had another business that was set up and I wanted to take some clients out and I paid that other business to take clients out hunting or something like that, you know, that could be done. And that could be a legitimate business expense for me. But, you know, mine is more of a personal investment. You know, mine is nothing I'm not trying to get any tax deductions. Mine is just an investment.
Sure.
So, and also for personal use too, for my stuff that's not owned together. But
so that was going to be kind of my next question there, Seth, is as we transform this thing, you just said neither of those properties had a structure on them. In my case, all of my properties have a structure on them that I take depreciation on. And so you're not taking any tax deductions there. So from an investment standpoint, you're purely investing on this in terms of appreciation of value?
Yeah. Yeah. I think this would be a good time. I'm just going to probably talk a little bit about of the advantages. I'm just going to go for a few minutes here. Just so when it comes to farmland for our investment. So I think it's a good thing just to back up a step here. There's something called 1245 property. There's something called 1250 property. 1240 property basically is personal. It's basically personal property. Okay. So when it comes for me and our farm, our ag land, basically, it's going to be our fencing. It's going to be our terracing, any tiling that we have, you know, any other structure that might be on the building that's not or on the property that's not a building.
Okay.
So in our neck of the woods up here, there's something called an excess nutrient deduction. So it's just that people have put on so much nutrients on the ground that there's an excess deduction that you can actually get for a tax deduction to take off your income taxes, basically, which is very common in our neck of the woods. So like to get the excess nutrient deduction, you know, here you have to have a licensed professional, an agronomist come in, so do some soil sampling for you, provide you whatever nutrients are excess and basically spell out how much of a deduction that you can take for that. That then gets put on your depreciation schedule and it can be depreciated off.
Interesting.
Same thing with tiling, terracing, fencing. You're going to be putting in like a new crossing or culverts, things like that.
So those actual efforts, like if I'm going in to do terracing in a field, those actual efforts can then be depreciated out.
That's correct. Yes.
Gotcha. What are those? What's terracing and tiling?
So just different actions of the land to make it, you know, usable for farming and erosion controls and things like that.
Okay.
It's basically all erosion control, basically.
Okay.
So, and even if you're not doing the work, if you buy a property that already has it on there, like in Iowa State University has a generic dollar amount per acre that you can use if you know how many feet, you know, if you know how much terracing that you have, how much tiling that you have. There's also, if there's fencing, a lineal foot per foot, how much fencing you have on your property, you can actually segregate that out for your taxes to help alleviate some of the tax bill on this.
Interesting.
So it's not a lot though. I'm not going to lie to you. It's not going to save you some, but it's going to save you some.
Yeah. And considering you don't have any like normal structures, let's call it, on the property, I mean, those are the only forms of depreciation you can get on a raw piece of land.
Right. Correct. Yeah.
Those can be done when you purchase a piece of property with those things on them already?
That's correct. Yes.
And so how do you, if without designating the value on them in the agreement, the sale agreement, how do you determine a price to submit that?
Yeah, that's a great question. So you would have to know, you probably have to, like for tiling, because tiling is the most common one. Terracing, you can see it on an aerial map because it's visible with the bare eye. So you can go on on X or whatever you guys use or whatever anybody uses and just draw a line for, you know, how many feet is it?
Yep.
And you can put a number to that.
Yeah.
For tiling, you'd have to know the actual amount of feet that are in the ground and have like a schematic of that, whoever put it in. to really substantiate your tax deduction for that. So
got it.
There would probably have to be some legwork, and if the owner doesn't know, the previous owner doesn't know, if you know who did the work, you'd have to probably do a little bit of research.
Backtrack it down.
And can you do the same thing with timber when we're talking about timber cruise? Are you able to take like a depreciation on timber when you do a cruise at the time of sale? Isn't that something we've talked about?
Yeah, so timber is a little bit different. It's the same. It's more like the nutrient deduction. It's more like mineral rights.
Yeah.
And I'm going to clarify one thing here. I'm not talking about timber businesses here.
Correct.
I'm going to be talking more about timberland investment properties.
Yep. Which is what most of our listeners are probably interested in.
I'm going to look at one today.
So the timber guys that are doing this for a living, they know the rules already.
Right. Right.
So timberland investment, though, on that side, you can actually have a bonded forester come in, give you a value of your timber on that land.
Yep.
That land then that timber value then can be cost segregated out.
Yep.
So if they give you, they're going to put it in merchantable board feet.
Yep.
They're going to put a value on the merchantable board feet at the day that they're doing it. They're going to give you a total price. You're then going to put that it's not a depreciation. It's going to be a depletion schedule. It's the same difference basically.
Okay.
I should probably back up a little bit. That doesn't have to be filed every year if you're an investor.
Right.
If you're the type of person that's going to be selling 1 or 2 times every 3 or 4 years, you just need to maintain that in your file for your records. Basically.
Got it. Just so it's always in there.
Just so it's always in there. It doesn't have to be filed with the IRS every year, but it does need to be in your records and filed. And I believe you should be filing it when the year that you do the sales as well.
Okay, so that's what I was going to say, Seth. So it's always in your file so that in the event of the year that you do some timber sales, it's able to be referenced.
That's correct, yes.
So I'm slowly remembering this conversation as we're having it here. In regards to, isn't it more like locking in the tax rate that you're going to pay on the timber based on where it was the day that you bought it?
There's two different pieces there.
Okay.
Yeah. So the crux of it is you'll be able to write off that timber basis.
Yep.
Tax-free, basically.
Yeah.
But it's going to be prorated on your board feet, basically. I like to. So you're going to have to find a method, and I think the easiest method is for board feet, basically.
Yep.
You're going to sell your logs, and they're going to give you a price for your logs for board feet. Your timber basis should be in board feet. Yep. So then you can just say, all right, we got X amount of board feet here. We sold for X amount of dollars. We're going to take that off our basis.
Mm-hmm.
So let's just say in your property that you buy, we'll just do some real simple math here. Let's just say, and you guys are going to be way higher percentage than what I would be here in Iowa.
No, it's basis.
But it's just a simple analogy. Let's just say it's 50%, right? Okay. So you bought a property for $100,000.
Yep.
You have a bonded forester come in, do this analysis for you. He or she derives that there is $50,000 of timber value on this property at the time. Half of your cost basis is now timber.
Got it.
So the first $50,000 of timber that you sell, you can sell tax-free.
Yep.
You're going to go against that. You're going to deplete it against that timber basis.
Got it.
And if you never do that initial timber cruise, you're going to pay 100% on the sale of that timber, correct?
No.
Okay.
No. The timber cruise doesn't have to be done immediately. They can actually go ahead and do that for you at a later date.
Retroactively.
Because they can, the forestry guys, now, I could be a little percentage here. I could just be off by a little bit here. They can calculate backwards to what, from the time where your timber was at this day, they can calculate it backwards to when you bought it, basically.
Yeah. The retro calculation.
I'm like, come on, Jed, that tree was probably 3 or 4 inches, and now we're 10 or 12.
Yeah.
If I remember correctly.
Well, and so, because I've heard of people having that, like when they ask somebody to come in and cruise it for sale, that at that same time, they then backtrack it to give them the basis and then say, okay, here's where you're at. Here's what you were at.
And I assume the further out you go, that there's a degree of accuracy.
Well, and I would say that there's an interesting, and to your point, Seth, maybe it's a little bit more relevant for people out of ag country than so where Jared and I are looking a lot of properties we own. You would be smart to try to take as much timber up to that basis, basically, because it's tax free, prior to selling that property in a, if you're talking about an investment piece of ground, right? So let's just use Seth's number there, $50,000. My goal would be to try to take up to $50,000 in timber off of that place prior to me flipping it back out there for sale, because that's tax-free for me. Now, how does that affect the value of the overall property?
Unknown, right?
Unknown. There's some
Depends on the buyer.
appreciation that's happened there. So is it offset? So, and I say that because not to put him on the spot, but Bill Winke was one of those guys who would go in, he'd buy a piece of ground, he would do that cruise, he would get that basis, right? He would cut those walnuts off, and then he would sell that back normally for at or right above what he paid for it.
Well,
but he had taken $50,000 or $100,000 in timber off, tax-free.
Yeah.
And then, that's how this thing got started.
Well, and I think the strategy there is like Bill's buyers are buying it because it's Bill's ground and because it's
but I don't think they were originally, because Bill Winke was just a writer. Like they didn't really. Bill Winke wasn't Bill Winke Midwest Whitetail.
Well, and ultimately because it's still a good piece of hunting ground, even though it doesn't have those walnuts on it.
You wouldn't even know it. That's what Bill would say, and you could walk through that property and see a couple stumps cut, and you had no idea. Meanwhile, he took off $1,000 walnut here and $1,000 walnut there.
That's a really interesting aspect to like land investment and ultimately selling is like what can you get away with taking off of the property without depleting the value of it to a majority of buyers.
People will tell you right now,
selling the oil and gas mineral rights, timbering
clear cutting it.
Sure.
People will say, well, we can clear cut a property and 5 years from now,
it's gonna be a great
sell
hunting
it
property
for what we bought it for.
Yeah.
Maybe. I don't know.
I think that's true.
Man, yeah, I wouldn't buy it. And I'm one person in the crowd. I'm just saying, like, I wouldn't. Anytime I'm looking through properties, if I see a clear cut piece of property, I wouldn't even look at it.
Yeah, but that's because you're really interested in the investment aspect of that piece of land
versus just the recreational piece.
I'm
also smart enough to know that somebody bought that, took all the timber, and now is trying to sell them to me for the same price.
Sure.
Sure.
Yeah. The other interesting thing is you wouldn't buy that land, like you said, and I would be in your boat. I probably wouldn't buy it either. But, if you're someone who is really wealthy and has generational wealth already, the cool thing about timber, which we don't have in our neck of the woods in Iowa, really. I mean, we have chunks of timber, here or there.
Yeah, saw a tree once. I've seen them. I know what they look like.
In the middle of the CRP field. Yeah.
Change the subject here. I'll come back to my thought, but it's funny because when we took our cruise with my forester and we did ours, he told me, he's like, you can just go up to like a tree and like, we have some walnuts in ours. And he's like, if you can put your arms around it, you just can barely not touch it within like 10 inches or so, that's good enough. So when he left, I'm walking up to trees and just hugging on trees and like hugging them, going,
like, look at Seth.
I'm going to catch this one in.
Seth will never cut a tree again. He loves them. Meanwhile, you're like, this one's gone. This one's gone. Yeah.
That's my method now of measuring trees. I hug them.
You're like, 1 minute. Let me just inspect this. Yeah, this one's good.
Yeah, we'll cut this one.
I try to do that when no one else is around.
Right.
What were you going to say there on the generational wealth side?
So, it's interesting when it comes to the hardwoods and not even just hardwoods, just woods in general, woodlands in general is, trees grow.
Yeah.
And, they're going to grow back.
Yeah.
And you want to talk about getting an investment that acts like a Roth IRA. Is you're going to look at woodlands. I mean, they act a ton like a Roth IRA because in an IRA in general, the Roth portion only to the extent that you have a timber basis to it.
Yep.
Right. So, I mean, they're in essence, they're not exactly like a Roth IRA, but the timber basis allows you to take income off with no taxes, basically. The growth of the trees, I know in Iowa at one time there was a study done on walnuts where like the first 8 or 9, I forget the exact numbers, but it's like a 2 to 3% growth on those trees. From year like 0 to like year like 18. And then from like 18 to like year 30, it's like 4 to 8%. And then like year 30 to year 48 or whatever it is like 18%. And those are just generic numbers. That's from an old study. But it's just interesting how you can look at how people don't maybe look at timberland as some sort of investment when it can be a tremendous investment actually. And really set up pretty structurally well as like a Roth IRA because you're not, or even parts of a Roth and parts of a regular, but it grows tax free with the growth of the trees.
Right.
If you do sell timber, if you're going to maintain that land for a long time, you can then sell the remaining timber and get capital gains treatment on it. So then you have preferential treatment as well.
Yep.
Then the timber can also be sold, you can do 1031 exchanges on it. There's just a lot of advantages of it, which I think is really interesting. So something that's fairly new to me yet, being in, a flatlander Midwesterner,
Well, it's new to us,
really
man.
Cool.
I mean, I'm, to Jared's point, I'm buying timberland properties. I mean, that's what I'm investing in with limited knowledge, but enough knowledge to know that if it's got good timber on it, it's a good investment, for now and for the long term. I think what's going to be intriguing and hopefully with this podcast as we build up, and it's going to be a year, over a year process, but, as I look at where my, let's say, basis is for the timber value, and then understand what I can sustainably take out of there, not just so I can get money and income tax free for this LLC account, right? But because I know it's going to improve the quality of the habitat for wildlife, which is why I bought the property, which in turn should enhance the value of the property overall.
That's interesting.
That's the fine line to run. And somebody wrote us, sorry, I didn't mean to interrupt.
No, it's okay.
Somebody wrote us the other day, Tyler, I can't remember his name.
Yep.
Is that who it was?
I think so.
Tyler?
If we're talking about the same thing.
Yeah. Wrote in and said, hey, you guys should look at the EQIP program.
Yeah.
Because of the way that I was investing in this, they allocated $500 or $600 per acre in EQIP. Plus they paid for a lot of this stuff.
Well, if you saw my comment, the guy that talked me out of it was Jed, who does a lot of writing for those plans and stuff. And I think he's come full circle on it now to where he's like, it's gotten easier. The process has been improved.
It's still a lot of paperwork.
It's still
anything with federal government, still a lot of paperwork.
Yeah, and as long as there's there's funding being put towards that program, we might as well.
What I didn't understand in that is if you're going to pay me $500 to $600 per acre to apply this forestry enhancement program or whatever they were coded as, I looked in my area. There's a lot of oak regeneration money right now. Do I also get the value of the trees that are being cut off as part of that program? That wasn't clear.
Yeah, you have to.
So you're giving me $500 to $600 per acre. Let's say it's 50 acres, right? At whatever, 500 an acre.
Well, yeah,
so
because
it's $25,000 plus the timber that I'm getting off of it as part of the program harvest recommendations.
I would assume that's how it works.
I mean, that's where you start to, people ask us all the time, Seth, like, how do you make money? Like, when we talk about these investment places, how do you make money on these properties? Obviously, at the point of sale, when we're done with the investment, that's how we probably make most of our money. But I think that there are opportunities: cash rent, timber harvest.
Dude, let me not lose that.
CRP,
Let me not lose this comment I was going to
go
give you a minute ago. I thought what you said was interesting in terms of, dude, if you could have just a timber harvest schedule that allow.
That's what I'm looking at.
Yeah, in regards to my question earlier about how do you keep funds in these accounts on the holding accounts, dude, just schedule a tree harvest, every year or every couple of years, in a way that you can sustain those bank accounts.
100%.
And the properties are essentially paying for themselves at that point.
Yep. Plus your equity that you got when you initially bought the properties. I mean, the fact is this. I love the term wealth because it means so much. And why we beat this dead horse, but why I love land investment from a wealth side is just like the joy wealth side. Because like I can literally walk on it and enjoy it with my kids, my family, myself, and like just love it. Like just be on there. And what other investment can you do that with? Yeah. It doesn't exist. So not only are you building financial wealth and securities, ultimately you're building the opportunity for like life wealth and happiness and use to actually have a tangible piece of property. Like my wife says, though, you can't fall in love with it because then you'll never sell it and make your money back on it.
Oh, I have the hardest time not falling in love with the whole. So I've bought and sold several farms over the years, and I bought one last April, actually, right after tax season. And
okay.
I'm like, this is the one. This is the one. I told my wife, I go, this is the one that, I've always wanted to plant an orchard.
Yeah.
And that's kind of like an end game, retirement game.
Oh, yeah.
Just kind of have like a chestnut orchard and, some of the agroforestry type stuff. And,
oh, yeah.
Like it had this little nice, it didn't have a lot of tillable, but it had enough, had the right soils for it. And I said, this is it. My wife's name is Jill. I said, this is it, Jill. Like, this is going to be our baby. Like, this is what
this is the one.
Retirement income. And I sold it.
Well,
4 months later, I sold it.
So wait, I guess let's take that situation, Seth. Like what in that case drove you to sell that property?
Yeah. So that property, because, as a hunter, it was amazing. Like, you want to talk about some
again,
of the best.
what drove you to sell the property? Yeah.
Yeah. So it was truly an awesome, like deer hunting property.
So great recreational property. You said it had
timber on it.
Some
I never
tillable?
had a timber cruise done on it.
Okay.
But it had 56 acres of timber on it, of Iowa timber. So there's probably going to be some walnut and oak through there.
Oh, yeah.
So, and then it had 29 acres of cropland. So what made me sell it was there is a slice out of the middle of our ground that we own, like the core of our ground is together.
Yep.
And there's like this 99 acre slice through the middle of it that another guy, owned.
Mm-hmm.
And he had reached out to my realtor, the realtor that I work for his company, and said he's thinking about selling it. And I told them, I said, if this guy ever reaches out to you guys, you call me immediately.
Yeah.
Because we want to get that 99 acres. And to make a long story short, I told my realtor, I said, just sell my ground. If this guy's he's reaching out to you to sell, mine sold. He wasn't ready to sell.
Of course.
So, but it's okay. I found another property. So I made money on it. At the end of the day, like, you tell yourself not to fall in love with it.
Yeah.
I just told myself that over and over and over and over again. Like, you've only owned it. You've made money on it. It's okay. It's okay.
So in those cases, Seth, you buy a property, you sell it, you make money. Obviously, you're looking for reinvestment. Do you give yourself a time frame in that? Do you feel pressure to reinvest that? I guess, that maybe that's the lead into 1031, but, I guess in that case, you thought you were going to buy a property, didn't turn out it was going to be for sale. So now what?
Yeah, so just a little background on that. So yeah, like I said, I bought this property, I sold it. I was kind of in the process of talking about price and stuff like that. When the gentleman decided not to sell the property.
Mm-hmm.
I then just kind of sat there and thought about it for a little bit, like, all right, how much gain do I have? Is it worth it?
Mm-hmm. Do you have a percentage in mind? Personally? Just
I didn't actually, no.
Okay.
I didn't. I really didn't at that time because it all happened so fast.
Yeah.
I was just, the way I looked at it was I own this 40 acres. I said so I had bought a 40 acres personally in between time.
Okay.
And I was like, if I sell this, I can pay my taxes. I can pay off my 40 acres.
Okay.
So I was like, instead of doing a like-kind exchange or having to do a reverse like-kind exchange, because the way it sounded like I was not going to be able to get the property that I wanted. So I was going to have to do a reverse 1031 exchange. And the fees on that are quite high.
Okay.
So, I mean, every company's a little bit different. And the fees were going to be probably like $17,000 on that, I think is what I was quoted. And I don't remember exactly what I made on the property, but it cut way too much into that, what I made on it. So I was like, well, my taxes are basically the same as what my fees are going to be.
Yep.
I'm going to pay off this property then.
Yep. That makes sense.
So I just turned around and paid off my property.
So now you've got this, in this case, you've got a 40-acre piece, fully paid for, all equity in it.
100% paid for. It's mine.
Yep. And so in your mind, are you already thinking like, how am I going to leverage that one?
Yes.
I love this guy.
So in the meantime, this other property that's been for sale, I have an addiction.
No, man.
Well, it seems like that would be the primary motivator. Like for me anyways, is like, what incentive do you, I realize that a certain percentage of profit, you're like, okay, now's the time to sell. Sure. But it seems more likely that it would be driven by more property being for sale that you want to upgrade to.
Well, in that case, you had a property that you knew less taxes, you could pay off fully, and then have this thing as collateral for whenever something else came up.
Right.
So that's
correct.
I think a lot of people, and including myself sometimes, like I'm trying to think next steps, but my brain isn't even letting me get there, which you need to be, because the moment I sell Ohio, which I eventually will, it's like, well, what's next? Another Ohio piece? Do I have one already?
What I'm saying is I think before that happens, you'll have your eye on another piece of property that you're like, I need to use this to roll in.
Which he did, right. But then the guy didn't want to sell.
Right.
So now it's like, what do I do?
Yeah. So in the meantime, after that happened, after I paid off my land, which is pretty wild, another property came for sale, that the wetlands property I was telling you about that I own.
Yeah.
So then I used the equity I had on that 40 acres and bought that wetlands property.
Yep.
So that was kind of my next plan, because I thought it was reasonably priced, and
that was via
sell it for a profit.
Via a refinance in that case, though, not a sale and subsequent acquisition.
That's correct. Just a refinance of everything. Yeah.
Gotcha.
Yeah. So then it's, unfortunately, the guy that owned the 99 acres then that I was trying to pursue, in the meantime, after I bought the wetlands, passed away.
Oh no.
Unexpectedly, actually.
Wow.
And yeah, I was just kind of like, oh man, this is, it happened unexpectedly. I didn't know the man at all. So
yeah,
heard he's a good guy, but I didn't know the man. So I've in the process of trying to sell that wetlands now and buy this 99 acres actually. So,
well, there's obviously nothing you can do about a death of somebody that's involved in a contract. But in regards to that first one where the guy decided that he didn't want to sell, in hindsight, could you have secured an agreement of sale with him that was just contingent on you selling, or successfully refinancing that prior property?
I mean, I could have, yeah.
Okay.
Yeah, and he didn't want to sell. I mean, I could have. I really wanted that property, so I was pretty hell bent on that at that time on that property. Like, if it's not that property, I just want to save it for something else.
Yeah.
So
cool. So it worked out in that regard. But
yeah,
to any of our listeners, if to prevent that happening, you may be able to take steps to secure the purchase, and just by making it contingent on financing on your end, so you don't find yourself in that situation.
Right. So So actually, I'm going to be selling that property now that I just bought. And
yeah.
So
speaking of us wanting to roll over some assets, buy some ground in southern Iowa where we can hunt every 6 years.
Yeah, right. I think it's interesting though when you because it sounds like Seth and again in progress, aspiring. You are at the point where your land assets are able to be leveraged to continue to accrue new land assets, which I don't think people, I don't know if it's that they can't ever picture it being at that level, but again,
well, you're building a machine, as long as you're able to make those monthly payments, these assets are building momentum for you to go out and continue purchasing more assets.
And what's frustrating for me sometimes is that it likely will start with your primary residence. Your primary residence is your foremost asset for most people. And maybe it's the Dave Ramsey mindset, which no knock to Dave, but we know he doesn't like debt and personal, debt. And I'm not saying that all debt is good, because it's not, but his mindset is pay off that house, like get to where you're not making.
Is it?
Yeah.
Okay. I was going to ask, because there's a lot of these big finance guys that are, well known or viral, if
debt
you will,
free,
that are, no, the other way. They're like, why would you ever own your own residence? They seem to be very opposed to that. I mean, Seth, is that a mindset that you've come across, or Jeremy?
Oh, I've seen that mindset from lots of people. Just always lever, like lever. And I think
what do you mean by that? Lever?
Just leveraging.
Just leveraging your equity, leveraging your income, basically
always
borrowing
against some debt.
Any equity that you have, borrowing against, any extra income that you might have, you're either leveraging your equity in some sort of property, or you're leveraging your income that you're making some way, shape,
collateralize everything basically.
Yeah. So, you see like a lot of these, one thing I despise is like all these TikTok and social media people that give real estate advice.
Oh, yeah.
And, they're like, just every 5 years you should be buying something. You'll pay no tax and blah, blah, blah. Well, it's like, do we not remember the housing crash a couple years ago?
100%. Well, it goes back to, can you afford it? Right. And in most cases, no, the answer is you can't. It's not possible. Like, I talked to somebody the other day even about like a property with a structure, which I have. And they're saying like, well, let's say I went out and bought an investment residential house. I paid whatever, $250,000 for a house. My mortgage on that on let's say even a 30 years is going to be, I don't know, $1,250, something like that. it comes down to, is it going to be making more than $1,250 a month in rent, minus expenses and taxes and everything else? Like, the odds are you're not going to make money. It's not going to cash flow anything, right? Like, I think when people start to think about, and we get this comment all the time, especially when I did a breakdown on my Ohio place, is they're like, well, Jeremy, I don't understand how you're making money. And it's like, I'm not making money on this investment every day or every month. Like I'm not. It's
specific
not,
events.
Yeah, it's not cash flowing.
Timber sales,
sale
of the property,
sell of the property. Like those are the things that ultimately
crop leasing on an annual basis.
If you've got
all gas
viable stuff,
rights.
yeah. I mean, there are a lot of individual events that can happen that can lead to revenue, eventually culminating in the sale of that property or the leverage of that equity to buy another property.
Dude, there's so many unknowns with land too. Like. You never know. Dude, my parents are perfect examples, and without sharing their exact situation, like, they never knew that the land that they were buying someday would be valuable for natural resources in the form of gas, or
solar.
Even today in the form of solar power. Companies wanted to come in and put. I mean, dude, you can make astronomical amounts of unforeseen money because of the acreage that you own. And there's really no way to plan for that stuff.
No.
But there's always a chance.
Well, yeah, and that's where, I think, Seth, where you're at in the ability, I love the, and it's just because it's my mindset. I love not necessarily like collateralize everything, but use your assets to the fullest.
Yeah.
Besides credit card debt, I'm a very
throw your weight around a little bit.
I'm a big embrace debt. Embrace debt as long as your assets outweigh it.
Cash flow.
Right? That's it. Now you have to have the cash flow to pay for it.
Yep.
But at the end of the day, if you've got $1 million in debt, but you got $2 million in assets, well,
and you have the sustainable cash flow to pay for it.
Your net
whether
worth
it's coming
is
from
$1 million
the
plus $1 million.
Yeah.
And then leverage those assets to continue to build. That's the thing is like it's amazing to me, and maybe it's just no offense, it's your generation a little bit.
Sure.
To talk to people that say, well, like I'm never going to have $1 million in the bank, and it's like, yeah, most aren't, including many multi-millionaires.
Yeah. They're
going to have millions of dollars in assets that their net worth balances out what they financed and what the debt is on it. And that's reality. And I think that as you start to look at the generational wealth, especially, it's the same way. I just met with a guy who has generational wealth. His father owned like tens of thousands of acres in this area and coal mined a lot of it, and then slowly sold it back off, as he was done mining it. And, now he's got very few properties left, but his wealth to him and his kids is enormous.
Yeah.
Because it's just been land assets that have kind of funneled down through estates and generations. And we talked about that, Seth. You mentioned like the estate planning side from a professional aspect, but that generational pass-through, which frankly is going to affect you at some point, is something that people probably don't pay enough attention to.
Yeah, absolutely. That's 100% true. So a lot of planning, because the land up by us is so expensive.
Yeah.
I mean, there's lots and lots of millionaires up here because it doesn't take a lot of land to have a lot of wealth up in our neck of the woods here. I was telling Jared before, but you were here, but a piece of land just sold for $25,500 an acre, $25,500 an acre, an 80 acres piece of ground.
Oh
so,
my gosh.
I mean, it's crazy, but so what I was getting at though is we're talking about generational wealth and talking about the positive sides of land investing with this is number one is depending how you own it. Let's just say you own it, let's just say, we'll say Jeremy, Jeremy has whatever land he has, owns it. He can pass away and leave it to his kids. And he can carry on between him and his wife currently $24.12 million of an estate tax exemption where you don't have to pay any estate tax on that. That's a tremendous amount of wealth that can be passed to your kids tax free.
That's a fixed number. That's not dependent on any of his assets. That's the number.
That's the number.
What is it?
Yes. It's so it'd be 12.06 million right now, basically. Per person. If you're married, you can join those together.
So my wife and I could essentially pass $24 million worth of real estate to my kids tax-free.
Tax-free, yep. And the interesting thing is that's for estate tax purposes.
Yep.
Okay.
Yep.
So now you look on the flip side for your kids. All right, then my kids gonna have to pay tax on that, possibly. But what happens upon death? And I do this a lot of times in my appointments. I'm just gonna kill Jeremy off first.
Yep, that's fine.
You're gonna
I'm the
pass away
oldest.
before your wife.
Yeah,
you know?
that's most realistic.
Yeah,
anyways.
most realistic.
Currently, the way the tax laws read right now, there's what's called the stepped up basis. So your land gets revalued to the fair market value on the date of your death.
Okay.
So if your basis is, doesn't matter the numbers here,
Sure.
guys, let's just say you bought it for $1,000 an acre. When
Yep.
you die, it's $5,000 an acre.
Yep.
That land is now your cost base in that land is now $5,000.
Okay.
So your kids could theoretically then, if they wanted to sell it and they didn't want to keep it,
Yep.
first of all, it can go to your wife.
Yep.
Your wife can own that land. When she passes away, it gets stepped up again to the
kids.
whatever the fair market value is at that.
Okay. Okay.
We'll just say it's relatively close. So let's just say it's all at $5,500 an acre.
Okay.
Your kids then have a basis of $5,500 an acre in that ground.
Got it.
They could turn around and sell it tax free then.
So if they sold it for $5,000 an acre, they'd pay zero taxes on it.
They pay zero tax.
And if they sold it for $6,500 an acre, they would pay that $1,000 an acre difference.
That's correct.
Amazing.
Yes.
Is there a difference though between this is estate tax versus an inheritance tax? Like those are different.
So inheritance tax is different. Yes, inheritance tax goes by state.
Because that's the real catch, right? Inheritance tax.
Yeah, well, sometimes the estate tax and inheritance tax gets confused for each other.
Okay.
Like what you hear a lot of times on different media outlets when they talk about, passing, taxing the rich and passing different types of stuff on. They're talking about estate tax.
Yep.
They're not actually talking about inheritance tax.
Gotcha.
Inheritance tax is done at the state level. So
Okay. That makes sense. So
a lot of times when people hear about it, it is the estate tax.
Okay.
Any idea how that works, or
in our state?
Do you?
I have no idea.
Yeah.
No idea.
I can't tell you in Pennsylvania. It'd be a great question for Pennsylvania accountants, so that would have more knowledge of that.
I don't know what mine is. I know that I've set up I've got kids, so I've set up wills for my estate and passes if I die or if Emily and I both die, how that goes. In fact, I've recently set up small trust funds for the kids, even from an investment standpoint. So like I'm looking at it from a retirement and from a wealth standpoint for the family and investment of lands. And then I've also set up, and this is my alternative. I'm not saying don't go to college, kids, but who knows what college looks like in 10, 12, 14 years, right? No freaking idea. So instead of putting money in like a 529 college plan for the kids, I've put it in a trust fund to where I think at 24 they have access to it. So if
that makes way more sense, dude. It's like buying a Visa gift card as opposed to like a Home Depot gift card. It's like, why am I going to take this cash and limit it to where I can use it?
Well, that's the thing it's like, maybe
I hate gift cards.
Maybe my kids want to take over the family business or they want to start their own business. Great. At 24, here's your fund. Have at it. If you go to college, when you're going to take out loans, and at 24 you can pay them all off with your trust fund. Like that's just how it's going to be. But I get frustrated when people, and I'm not saying that 529s aren't a good investment plan,
because they think that college is the right route and they want to ensure that money gets used for it.
100%. And it's, I don't know what my kids are going to want. They may say, I hope they say, Dad made a bunch of money on land. Like, I want to take my trust fund and start investing in land. Great. Do it, man. Leverage your assets. Go for it. Mm-hmm. You don't know, but you want to make, and so that's why, and I say that, Seth, because Jared and I sometimes say, I won't say we're against paper funds because we both have them, but we've definitely started to focus more on the land asset side in addition to some paper funds.
Well, we're extremely intrigued by it, not only the security but the ability to impact and grow our investment, and also we love to hunt.
Can we pivot this just because I know Seth's probably gonna be low on time here soon. Talking about self-directed IRAs, because that's one that I'm interested in. In fact, I just opened self-directed IRAs recently. I moved one of my previous employer's retirement accounts into a self-directed account. And there's not a ton of money in there. There's 25,000 or something like that. Anyways, my next interest is how to leverage that self-directed, and I get a bunch of mixed signals, Seth, on that in terms of like, well, number one is like if you buy it with a self-directed, like you can't even step foot on it. Like don't be around, like you can't touch it. You've got a custodian, like you can't do anything. The other one people say is, Well, if you can't buy it in cash with that self-directed IRA, like you're not going to be able to finance with it. So what is your experience, I guess, with self-directed IRAs? Because that's something that's, I think, been more of a hot topic for us.
Yeah. So self-directed IRAs they're murky water.
Yep. I like living in the murky water, though.
I'm not against it at all by any means. So the thing with self-directed IRAs, basically is you can't put any sweat equity into them. You have to pay to get everything done.
Okay.
So I mean, you're going to have to find a specific type of property that I think if you're going to do this, I think you're going to want something that's going to have more income generating property in it.
Mm-hmm.
I don't think you probably want to put a woodland in, a timberland into a self-directed IRA. The reason I say that is, the timberland itself already acts like an IRA.
Sure.
So much of it already does. So what's the point of it?
Exactly.
The point of an IRA is not to pay tax on the earnings of that money, right?
Yep.
So I would probably shy away from doing that. And basically, when it comes to self-directed IRAs, there's a lot of rules.
Mm-hmm.
I'll go over some of those rules basically. So you cannot contract with any parent, grandparent, child,
right?
Any lineal descendants that are close to you.
And when
uncles,
you say
nieces, nephews, strangers, basically.
When you say that, Seth, you mean like I can't go out and buy this house with my self-directed IRA and then basically say to my mom, like, hey, you can go live there.
That's correct. Yes, that's correct. You cannot borrow money from them for this either. There has to be some separation with lineal descendants, basically.
Got it.
Out to the aunt and uncle level.
Yep.
In what regard? So you're talking about using the property. You're talking about financing the property.
I'm talking about using the property, financing the property.
They can't be involved in the deal
them,
at all.
Selling the property to them.
Okay.
You can't buy property from them, sell the property to them. You can't finance from them.
Mm-hmm.
You just can't have any contact with
them.
Yep.
Ever. Okay. When it comes to these investments, it has to be completely away from any family-related business or any common control business.
Got it.
So if you have, if you're invested into a different business, a different LLC, you can't have more than 10% ownership in that LLC.
Yep. That makes sense.
And one more time for me on that.
So if you are invested in a different LLC.
So give me an example. So
like if I'm in Deer Grow, I own more than 10%. Deer Grow can't go and buy that property, or I can't sell it to Deer Grow because I own too much equity in there.
So you would, for the sake of conversation, be considered like a relative in that sense. You also can't touch it.
Okay. Common interest.
More than 10%.
There's common interest in it.
Gotcha.
So, yeah. So that would be a disqualified transaction.
So in the same sense, you couldn't buy a piece of property under, let's say, an LLC that you and I are partners in, and then sell it to me.
Correct.
Because we have
common
shared
interest.
Yep. Okay, cool.
Yep. That's correct. Yeah. So basically, the entity cannot be a corporation, C corporation, S corporation that you're investing in. It can be a partnership. It can be land. Can't be a trust.
Yep.
So you're limited a little bit that way. You're going to be buying more of a property itself.
Yep.
Just straight outright, basically.
Yep. And going back a step too, Seth, you mentioned, and this is something I really dug into is, a lot of us, and probably the three of us especially, we like the sweat equity aspect, right? That we know that if we put effort into something, like we're going to get a financial return out of it. You can't, right? You entrust the custodian to then go hire somebody to do that stuff. You physically can't, which again, cost out of your pocket or out of the IRA means you're not getting as much sweat equity out of that property.
That's correct. Yeah. Yeah. So, the gray area is what can you do? What can't you do? Right.
Sure.
There's a ton of stuff out there that you can read. And, I'm not sure anybody really knows 100%,
Well, there isn't. I mean, that's what I was going to say, Seth, is like, I've dug into this cause I'm in one, right? I have one. And so here's the situation that I've found as clean as possible that would make sense. Is basically you find a piece of property. Let's say there's a great timber tract that you want to buy for hunting and it has a house on it. You survey out that house and buy the house with the IRA. You buy the balance in a conventional loan. You don't touch that house, but you can then have the custodian rent that house out, of which generates income. And if it's not
custodian, you can't rent it out yourself?
No. Nope.
You have to pay somebody money to rent the house.
Well, there's a
for you.
custodian that would be the one collecting the money and doing the renting.
And a custodian is somebody
that is assigned
who
to
do they
your,
work for?
They technically work for your IRA account.
Who assigns them? Is it assigned or is it somebody you go out and get?
So I'm with a company that does self-directed IRAs. That account manager is the custodian on my IRA account.
Okay.
Yeah. You can't go out and set up a self-directed IRA like Jared Prussia self-directed IRA.
Yeah.
You have to use some sort of company to be able to set it all
it just
up.
seems like the person who sets that up for you is maybe not going to be as good of a landlord.
Doesn't matter. Yeah. So if that person, writes and says, hey.
So what happens if something breaks in the house?
They would tell them, and then they would say, hey, you need to fix this, and you would have to go contract somebody out. You can't have any touch points on it.
That makes no sense.
I'm just telling you.
You should look into the checkbook IRA. It's called the Checkbook IRA LLC. It allows you to do a little bit more of that.
Okay.
It allows you to handle some of that stuff. You cannot go and put any sweat equity in.
Correct.
You know, you have to contact somebody else in that situation to do all the work.
Yeah.
And
I do have
I just imagine somebody in the house being like, can't break a sweat.
Well, I do have
I'm going to fix this hanger here, but I can't
fix it. You can't step on the you can't be on the property.
You can't be on the property at all ever.
When you first buy it, you can look at it and do that stuff.
This is what's crazy. Who's going to enforce that? Was the IRS going to be like, I know you killed that booner off of this buck and I can prove it? And
I mean, that's where we've talked to people who have said like, so the other situation was tillable ground. Like if you buy, let's say there's 50 acres of timber and 10 acres of tillable, survey out that tillable, buy it, cash run it. The biggest thing with a self-directed IRA, so I do have a checkbook as well, Seth, so I can virtually write it, even though it's technically the custodian is passing it off. I am controlling the finances there through this account. Okay. I use a equity trust company is who I've used for my self-directed IRAs. I'm sure there's a bunch of them out there. Anyways, what is key with that self-directed IRA is that the purchase has to make money. If it is not making money, then it won't be approved, basically. You can't just buy something to own a piece of ground and never make money with
making more money than the mortgage?
It just has to be making money. So that's why I said,
like ultimately at the time of sale, or
no, like in a return on investment standpoint. So this is where I think, and again, I'm not knowledgeable enough to know.
Yeah, we're just shooting shit here.
Most people have told me that you can't, or it's unlikely to finance something with a self-directed IRA because your mortgage and interest and stuff likely aren't going to be covered and make money. There's not enough funds to do all of that and make money.
Okay.
Again, I'm not saying that is true. That's just what I've been told. Versus if you buy a house, let's say you have $100,000 in your IRA, you buy a house for $100,000.
I think Seth, you own property with an IRA, right?
Yes.
How's that work?
Well, yeah, why don't you tell us about that property?
I don't know.
Because we're just going to keep circling it here.
I wouldn't do it again if I had my choice.
Yeah.
All right.
You gotta do everything once.
Yeah, you gotta learn. No. So to answer your question, yes, you can borrow money inside your self-directed IRA.
Okay. Mm-hmm. So you are essentially, your IRA is financing that purchase.
No, the bank is.
Okay.
So it becomes tricky when you get a bank involved with the self-directed IRA.
Okay.
You cannot personally guarantee everything.
Correct.
So you have to find a bank that's going to be willing to work with you. First of all, it's going to be almost impossible.
I was going to say, that's probably why I've been told you can't do it.
It's virtually almost impossible. And then, you're going to have to put enough because they're going to want so much down. You want to talk about leveraging. It's going to be the opposite of leveraging. They're going to want you to put it 50, 60% down, 70% down.
Yeah, they don't want to finance hardly anything because they
don't want to take any risk for you.
Yeah.
Because they may be believing you guys, you as a person, but they have no faith in your IRA constantly being able to fund any shortfalls in that.
Which is why a lot of people say that you need to have enough money to buy it and cash outright from the IRA.
Right. That is 100% correct. Plus, it's called unrelated debt financed income is what it's called.
It's a mouthful.
Yeah.
Unrelated debt financed
income. There's an acronym, UDFI for it.
UDFI, obviously.
UDFI. There's always an acronym.
UDFI. No, UDFI.
But yeah. So basically you bring a lot of stuff into play then, right?
100%.
So you're going to have a hard time leveraging. You're also going to probably have to file a tax return. So you're going to have to file what's called a 990T tax return. If you have debt tied to your self-directed IRA, you could possibly owe tax in it. So basically what happens is, I'll just give you a brief scenario, right? So we'll go back to this $100,000 number. Let's just say you bought, doesn't matter. Let's just say it's farmland for $100,000.
Okay.
The bank required you to put $70,000, 70% down. Okay. So you put $70,000 of your IRA money, you bought this land, you borrowed $30,000. So let's just say it's a 5% rate of return. You got $5,000 of rent on it. Okay. So now you have levered 30%. You have 70% equity, you've levered 30%. So 30% of your income that you took in is going to be subject to a tax.
Got it.
At a trust rate. So 30% basically of that $5,000 then was going to be considered income on a 990T tax return. You'll be able to deduct the interest on it yet. And any other, if you have insurance, if you have, you name it, whatever else you might have. There's not going to be a lot of deduction for it.
Right.
That's going to come down to whatever net income that you have. You'll pay a tax on that 990 possibly. So it depends on how much you've levered. The less amount that you lever, basically, the better off you probably are.
Right. That makes sense.
So what happens when you complete that purchase, when the financing is done, you've made all the payments? What happens at that point? So your IRA owns it outright.
Yep.
What happens at that point?
Nothing. Just you go on as owning it.
Yeah. So
fully outright.
The hope is that piece of property or structure or whatever is making money, which is then going into your IRA tax free. And then eventually, if you decide to sell that property, then it would roll into your IRA tax.
So why are you advising against? Advise is probably the wrong word. I know you're not doing that, but why wouldn't you do that? Because couldn't you buy a piece of property, make it as income producing as possible, even lease it out for hunting rights? You know what I mean? Because you can't.
We talked about that with Dan Perez.
You can't use it at all until it's owned by your IRA,
and you still can't use it.
And then you still can't use it. But then can you leverage that tax-free income to buy another piece of property?
No, it's a retirement investment account. That's why it's tax-free. So essentially,
you're just building that IRA.
You're building assets for retirement.
With an asset you can't use.
Correct.
You could leverage it at that point, though. You can. I mean, you can't. You're gonna have to find a bank to allow
for
you
another.
to do
that. 70% down.
Yeah.
I mean, it's gonna be not very good leveraging, though.
Yeah.
And should you is the next question.
Yeah. Should you leverage it?
Should you leverage it? I mean, should you? So the trust rate base is very high. It's
I was going to
40%.
say, is it
40? It doesn't take long to get to 40%.
Yeah, that's crazy.
So I mean, if you have a net income, it doesn't take much income to get to 40%.
So the tax.
Where does that happen?
So when you leverage something under an IRA, it is subject to tax. That part is.
Yeah.
Then you're paying that extreme high tax rate.
Okay.
On that.
Well, so subsequent question: if it's not a self-directed IRA to buy land or any other investment, maybe that's a direction that we would go. Is there another way to make those funds usable outside of the account that it currently sits in? Probably not, because it gets
No, I mean, because then it becomes just a normal paper IRA. I mean, that's what you would do.
You can draw the money out of those accounts.
Yeah. Subject to your income tax.
How much?
Your taxable.
What's the tax rate?
Whatever ordinary rate you're in, plus a 10% penalty.
A lot. Yeah. 30 plus.
But if it can be used to invest in a piece of land that you can use.
Yeah, but you're paying 30+% taxes. If you have $100,000 on there, you just lost $30,000 to $35,000 of it. It's not worth it. It should be. I think the thing is that again, and this is just part of my strategy at some point. Like, I don't know if I have enough to utilize it. I have it there in the situation that a property comes up and there's a piece of that property that makes sense for me to use a self-directed IRA, meaning a house.
Yeah, save you some money.
A tillable ground that I'm not going to put a blind in the middle of. I'll hunt the fringes. I don't care. But I'm not going to hunt the middle of that tillable ground, and I could cash rent it out or whatever. that is why it's there. For me, because of the area, I'm not in Seth's area where cash rent's $200 an acre. It's probably going to be in terms of a house, of which I can segment the house out, survey it out. I can rent that house. That rental income would then be my revenue, my income into that 401k. I've deducted that cost out from the rest of the property of which I buy conventionally, and that's really what I wanted anyways to hunt.
The land, the landlord relationship to that property still seems murky.
Here's a really good example.
I understand what you're saying with the cash book. That does help.
And I don't necessarily think this will work. It might though. So my neighbor in Kentucky owns 200 acres and a house, right? I need another house like I need a hole in my head, right? I've got every property I bought has a freaking house on it.
Means he doesn't want it.
Yeah, right. But I want the land, right? So, and then in the flip side of that, I don't necessarily want somebody else to buy that house that's now sitting in the middle of my bigger tract of property.
Sure.
So what I would try to do, hypothetically, is I would say, okay, I'm going to buy this. I'm going to survey out your house. I'm going to buy that with a self-directed IRA, and I'll make it an Airbnb, basically. It'll be Airbnb. That'll be the income that can come in. I buy that house straight out with my IRA. I conventional loan the rest of the property, probably leveraging my Kentucky place because it's got equity and it's adjacent. Mm-hmm. And I roll that all together. And now I control that house as an Airbnb, which is making income for my IRA. And I haven't lost it to anyone else. Yep. I didn't have to buy it outright as part of my conventional loan. And now I've got another house I don't know what to do with.
And the only contingency for financing, if I'm understanding this right, is that the rent that you're going to charge somebody to live in that house has to outweigh the mortgage that you're financing it with.
And technically, if you leverage it, there's a subject of that revenue that will be, or that a portion of that revenue that will be subject to
so
tax.
let's say same situation. You buy the house for $100,000. You use 70 of it from your IRA. 30,000 of it is financed.
Correct.
You charge $1,000 a month, so you make $12,000 over the course of a year.
30% of that would be subject to tax because I leveraged it.
Okay.
The other 70% would not.
So that's $1,300, roughly.
No, $3,600.
$3,600. Okay.
That would be subject to tax at a higher tax rate.
Okay, so you're left with whatever, $9,000.
$9,000. Mm-hmm.
And
then that goes into my IRA.
Because you're going to have to pay. I don't have a calculator in front of me, but
it's
gonna be close.
This is why I'm saying. Well, no, at $100,000, you'd be paying like $490 or $500 in a mortgage if you can finance it.
Yeah.
Odds are you won't. That's why you want to have enough money in that IRA that you just buy that house outright.
Sure.
So then it's 30% taxable, 70% goes in the IRA that's not.
Yeah.
Eventually you pay that leveraged off, or you wouldn't have a leverage, I guess, if you bought it outright.
Right.
All of that's going into your IRA tax free. So if I Airbnb'd it out for $1,000 a month, $12,000 every year goes into my IRA tax free. I technically own that house as my Jeremy Flynn IRA, but I also now own all the property, which is what I really wanted.
Yeah, I like it. I'm going to let you get a little further down that road with the...
I'm going to do it. I mean, I've already started the process. The thing is that it has to be, I think to Seth's point, a really, really defined situation for it to make sense.
Yeah.
Because I think you can get yourself in trouble pretty quickly if you do it incorrectly.
By a self-directed agent.
You know what the penalty is for a prohibited transaction?
Yeah.
It's a 100% removal of your IRA, basically.
Wow.
So that means they're gonna treat all of that $100,000 if it's prohibited. It's being taken out as a distribution 100 right away.
Wow.
With the 10% penalty.
And your tax bracket.
In your tax bracket.
So you're gonna hit with $30,000+ in taxes.
$30,000.
And that's if you get caught violating the self-directed IRA.
Violating these things. Doing any of these prohibited transactions, you can't provide any goods, services to this.
So here's a unique situation to it. I'll keeping that same breath, but my Ohio place is in the same one. There's a neighbor that owns 50 acres and a little cabin on it. Going back to like, how do you value different things? If you're going to use your self-directed, let's say I've already committed to buy the property, right? you go to them and say, listen, I know your house is worth more than $100,000. I only have $100,000 in this IRA. So as long as you get all your money, you're happy, right? The answer is going to be yes. I need to value this house at $100,000 to be able to buy it outright with my IRA as part of this transaction. And then the rest dumps into the remainder of the property that I buy conventionally. Mm-hmm. So people get caught up because this was the first thing I asked them. I was like, well, like this house is $100,000. Like I only have 50 grand in that account. Like how the hell, like it's going to take me forever to invest into that before I could buy it. They're like, well, just negotiate that the value of the house is 50 and you just dump the rest into the balance for your conventional loan. And you can get away with it.
Dump the rest into the balance for your conventional loan.
So if the property, let's say there's a house in 100 acres, okay? Yep. Say the 100 acres is worth $500,000 and the house is worth $100,000. You have $600,000, but you only have 50 grand in your self-directed IRA.
Yep.
Just make the property $550 and the house $50. Buy the house outright.
Oh, I see. Because the owner of the house also owns the land.
Correct.
So it's the same pot of money.
They're getting the same pot of money, but you're able to use your self-directed.
Does that ultimately come back to bite you because that asset that you're buying on paper is not as valuable as it actually is?
Doesn't matter because out of the gate, you're just looking at it as income generating for your IRA.
Sure.
So you're going to rent it out for $500 a month and that goes right into your IRA.
It would be at the time of sale that my question is relevant.
It's tax-free anyways because it's an IRA. So it doesn't matter about your basis.
It's tax-free.
Because it's an IRA owned. You don't take any money from it.
Cool.
So I almost used, I wasn't ready for it, but my plan was to actually do this in Ohio. So Seth, for anyone's listening to this, when I bought my 130 acres in Ohio, it has a farmhouse and it had a cabin on it. My plan was to segment out the farmhouse.
It is less depreciation you can take though, right?
Yes, but I don't know how the tax and depreciation works on an IRA because it's not for you. It's not showing up on your schedule.
Yeah. So you can actually, if you had, it doesn't matter if you own it outright, the depreciation doesn't matter.
Exactly.
Because it's tax free anyway.
It's tax free anyway.
So even if you did depreciate it, it's fully depreciated. If you sell a property that's fully depreciated, you have to recapture the depreciation on your tax return as an income. So either way, it's going to be tax free.
Got it. Yeah. So yeah, that makes sense.
The one thing I'll just comment one other thing on that is if you did borrow the money for that and you have this UDFI money borrowed, you can take depreciation on it to help lower the tax you'd pay.
There you go. Yeah, that makes sense.
It still is an expense for you, but it's only going to be 30% expense, right?
Mm-hmm. Yeah. So my cabin place, I was going to keep the cabin in acreage. I was going to survey out the farmhouse. Farmhouse is currently rented for like $350 a month, something like that. My plan was to try to buy that house outright with my IRA. The problem was I was disorganized and I didn't have enough funds in there yet. And in the market, the pressure was to like just get the deal closed.
Yeah.
In a perfect world, I would have bought that house for, let's say, 50 grand with my IRA. I don't need it. I don't touch it. I don't do anything. That $350 a month goes right into my IRA, tax-free. I segment that out from the rest of the property of which I bought conventionally. Mm-hmm. And then eventually I would have sold that house and that money would have dumped back into my IRA as well. I didn't have time to do that. And so what I'll do in the future is I'll eventually survey out that house and just sell it separate, but I'll have to pay capital gains on it.
Right.
When I wouldn't have had to with that IRA investment.
Okay. That's a big deal.
And keep in mind, I mean, I think a lot of people listen to this and said some of your tracks have been different. Almost every track that I've engaged with, even some of these ones we're looking at listing here for whitetail, all have some structure on them.
Yeah.
Right. And in most cases, if you're buying it from a recreational ground, you may want a structure on it.
Cabin, sheds, pavilions.
But you may not. You may say, well, I'm only 30 minutes away. I don't need a deer camp on this thing. It's a great way to segment that out and do a self-directed and have a form of income for your IRA tax-free and still get the rest of the property in a conventional
Especially,
the way you want
and it seems like there's a lot of them around here. We've got farmhouses or original homesteads that are like just across the road from the property. So like in that sense, yeah, you could cut that off, buy it with your IRA, and then own the rest of the property with a conventional loan.
Yep. And so that's my plan moving forward. And personally,
you said it's a custodian, and that's assigned to you via whoever you're using to set up the self-directed IRA?
Again, to Seth's
that's
point,
an interesting aspect.
You can have some involvement. Like I do have a virtual checkbook that I actually can pay a handyman to go fix this or do that. But technically it's being done via a custodian of the account. That is the thing, is you have an arm's reach from the activities happening on that property.
Yeah. So obviously you have a say in like what the rent is and how, what's paid for repairs and stuff.
Correct.
As the owner, you have to control that.
Correct. But keep in mind, you're not the owner. Your IRA is the owner.
Right.
Which,
well, just like your home, like the bank is the owner.
Yeah. So yeah, it's an interesting thing. I think it's something I'm definitely going to use it. When I'm, have everything set. I literally just got everything transferred over. Here's the other thing for self-directed IRA. Obviously, there's a lot of rules and regulations via the IRS, Seth, in terms of the amount of money you can put into these things every year. Whether it's a Roth IRA or it's a traditional IRA self-directed to use, there's caps and income levels that you can do stuff on.
Here's maybe a stupid question. Is an IRA an IRA, and just the point that you decide to buy a piece of property with it, that's when it's become self-directed? How do you build this self-directed IRA account? Where does it come from?
So an IRA is just an IRA. You're correct on that.
Right.
So you can do a self-directed IRA and still do your own investment. You can buy Apple stock. You can buy, you can buy bonds. You can put it in CDs. You can do whatever you want in a self-directed IRA at that point.
Okay.
You can invest in not everything. There are certain things you cannot invest in. Collectibles.
Yep.
You cannot have life insurance policies.
Correct.
Like I said, corporations, any trust, things like that. But for the most part, there's a lot of good literature what you can and cannot invest in that's out there right now.
I think the big thing is that there are certain companies. I mentioned Equity Trust because that's just who I use. There's a whole bunch of different ones, I'm sure, that set it up in purpose use of self-directed. Whereas like if you go to Vanguard, right? Vanguard, which is a huge kind of money investment market.
Yeah.
If you sign up for an IRA through Vanguard, that necessarily isn't set up to be a self-directed IRA.
Sure.
In terms of the management and the purposes and structure of that. So if you're going to do it, you can't say, well, I have an IRA. Here's the other thing. If it's an active IRA, like through work, you can't use that as a self-directed right now. Because
meaning if it's being fueled by like a retirement account?
Because it's part of a corporation that is investing in a multi-member strategy of IRA versus if it is a closed account. So for instance, my money came from Cabela's. When I worked at Cabela's corporate, I had an IRA there. It was inactive. Like it was still there. It was up and down with the market, but I wasn't actively investing, nor was Cabela's because I'd been gone from there for years. That was then able to be moved into a self-directed IRA to be applicable for use. I couldn't move my Stone Road Media IRA into that because it's part of an active multi-member IRA that's in progress.
So at this point, if you wanted to, could you, and how would you fund that IRA account?
You can invest in it. Yep.
How personally? Do you just put money in it? Like, I know with a Roth, there's an income limit,
and it's post-tax money in a Roth. In a traditional IRA, it can be pre-tax money.
Okay.
Yep.
So if you are self-employed, you can contribute to a self-directed IRA through your business.
Correct.
You can do, if you have a simple IRA and you're self-employed,
and why?
SEP IRA, if you have a solo 401k, you can do that into your self-directed funds. You can fund those through those businesses.
Okay.
See, like I can't fund it through Stone Road because all of our employees, all of us are in on a multi-member IRA. So I can't just say, well, I'm going to start a self-directed. It doesn't work that way. Right. But I did start a self-directed via a rollover.
Yeah, funds that existed prior.
Exactly.
I'm with you.
But now there's certain thresholds. I forget what they are. Seth, you might know. It varies from year to year. Like I think the self-directed Roth is like 6,500 or something like that. And the other one's, I don't know, 14,000 or something like that.
So this would be pretty relevant then for somebody who maybe has just like left a position, like a career they're in for a long time, and prior to rolling that over into...
Correct. Yeah, instead of rolling it into another just normal IRA, you could roll it into a self-directed IRA.
Gotcha.
Yep.
The better question is at that point, should you?
Yeah, should you?
Yeah.
Very, at that point, you got to be getting close to 60.
Yeah.
Now we're talking about being able to draw monies out of those accounts, not tax-free, but we can draw money out to supplement those and not have a penalty.
Yep.
And all that money has to come out at some point.
Yeah.
Out of your retirement accounts, it has to come out at some point.
Yeah.
At 72, it's coming out
no matter what.
R&Ds. Yeah. So the harder thing is part of the reason thinking holistically about this, that I may tell people, think about this long and hard before you do it, is because at some point, what's your end game, right? Your end game, at some point, you have to use this money and it has to come out of your account. Now, if you're stuck with too many land or too many hard assets, you're going to have to start selling assets in your retirement account, which is tax-free.
Yeah.
That money is going to have to then be drawn out as ordinary income to you. Granted, it's going to be probably 72 when you're 72 or later. So, there's a fine line of having maybe too much in there, where you don't have enough money to draw out. So at 72, the rough number is roughly 4% of your account balance has to come out in cash.
Yeah.
So long term, you need to make sure you have enough cash if you have these other assets in there, or be willing to sell those assets to take your R&Ds.
Yeah.
There's something to think about as well.
Well, and I think, and again, not a financial advisor by any means here. I don't think that you want your self-directed IRA as your one and only primary IRA. I don't think that you want that. That I have another primary IRA for long-term retirement stuff.
It's perfect for your situation because you didn't retire, but you left Cabela's early, and I
could have rolled it into the standard IRA if I wanted to.
Right.
I'm looking at it, and again, it's probably unique situations for like maybe a real estate investor. I'm looking at it as it becomes a fund that I will invest as normal until a real estate opportunity presents itself to where I'm like, man, I really don't need that house, but I want that property. I can leverage this to buy that house and make money tax-free and get the property I want.
Yeah. It's an interesting tool because it's not at all like a traditional real estate investing strategy.
And keep in mind, you're not going to do anything else with it, right? It's just going to be paper funds that are traded to retirement till 60 years old plus, you know?
That seems to be the twofold there is, like what you said. So first is you're trying to grow the IRA.
Correct.
That makes sense from a long-term investing strategy.
Mm-hmm.
And two, using it as leverage to complete a transaction on a piece of land that you do want. If it's just a piece of the financing that's being done.
And think of it this way to what Seth was saying in terms of age and stuff, right? None of us are close to that retirement number right now.
Yeah. It feels like it, but.
Yeah. If I invested, let's say I bought a piece of property with that self-directed IRA, it made money, eventually I sold it, that IRA is now whole again, right? With no asset. I can roll that into my traditional IRA. I could just be like, well, it made a ton of money. Now let me roll it in my traditional IRA and ride that out till I retire.
Cool.
Again, where I'm at, and maybe it's not the best financial practice. I like the aspect of being able to leverage that into a tangible asset that I can see that maybe benefits me, because I think about buying a house for $100,000 and carving that out of what would have been on top of a traditional loan for the rest of the property. You might be saving $20,000 in a down payment.
Sure.
Plus all the interest that you're saving because you bought that in full. So I think as you look at your diverse investment strategy, and this just isn't in land, if you're looking at saying, well, I could put some money in this self-directed fund and eventually use that fund to buy a piece of the property that I want or a structure on the property that I want, it becomes a very strong tool in your toolbox long-term to have that ability to do.
And like you said, Seth, it doesn't have to be land, right? If it's self-directed, it can be put towards anything that's going to grow.
Just like a bank account. You want that to be actively making money when you're not using it, right? So that's the approach I'm at. I don't intend to buy any property in the next 6 months, 10 months with that. Mm-hmm. So I'm going to actively invest where I'm able to invest in it. And I'm going to have it making money, hopefully, like a normal IRA. And then when I need it, I can sell those stocks off, and then I can push that and use it for real estate purchase.
Yeah, it makes perfect sense.
So
I agree in your situation, Jeremy. I think in your situation, the scenario that you're saying, you'd be using it correctly. Not everybody's scenario. If someone's going to do this, thinking about this, I wouldn't always recommend it. But in your scenario, and if it helps part of this to get this land acquisition, 100% go for it.
Yeah, and that's where I think I'm looking at it is, again, it's almost like I won't say a rainy day fund because it should be actively making money even when you're not using it for real estate. But it becomes a really cool tool that
just
may
another
be
leg to stand on.
beneficial. Yeah, if a structure comes up on a property that you want to carve out, and if you think you can make money on it.
Sure.
Just for the listeners, the devil's advocate to that would be just something to think about is you're giving up depreciation on a property.
Yep.
You're giving up the stepped up basis.
Yep.
You're giving up preferential tax treatments of, selling the recapture of depreciation of real estate is capped at 25%. So, I mean, you're giving up some preferential treatments that the IRS already has set up in place.
Yes.
And that can be okay.
Mm-hmm.
It's not necessarily a bad thing, but just so people understand, you would be giving up some of those things by owning a structure inside of an IRA.
That makes
I'm not
sense.
saying it's a bad thing or a good thing.
No.
I like the idea of having, I think for most people, it's a better way to understand, because most people have a knowledge of rent, right?
Yes.
Or, in that situation.
That's the easiest knowledge to have.
It's easier to understand that than, all right, I invested in, the fund the American funds or whatever funds that you have, it's invested in, 500 companies, and how does this actually work? It's just easier for people to see and understand, which I think is a huge thing when it comes to investing.
Well, and to your point, Jared, in terms of, I know we got to keep hands off and the sweat equities out of it, but you could still go pay a contractor $10,000 out of your IRA to go and remodel that place that maybe enhances the value by $20,000. So when it goes onto the market, again, tax-free, all of those profits go back into your IRA, and you're set up to do it over again, or have it, or roll it into a traditional if you want just paper funds with it.
You just brought up an interesting point. That's probably a negative against it, is you're limited to how much money can get put into that account.
Exactly.
So if you don't have enough money to pay for someone to come in and remodel your house, you can't put any other money in there. So your hands can be tied a little bit in these situations too. So
and that's where I'm at right now, is that I rolled over a non-participating fund, basically. That gave me a start. Now I can invest X dollars per year at a cap to build that up to where I can buy something outright. But right now, unless the seller says, yeah, that's fine, I'll value this at whatever, $40,000, even though it's worth $100, I don't have enough funds to buy anything with it outright.
It is interesting to your point there, though, Seth. Like, if you only have $40,000 in that account, you use that to buy the house, you're completely you're essentially living month to month on rent as far as that IRA is concerned, to pay repairs, damages, anything,
you just have to have, again,
and taxes, right? All the expenses.
All the expenses come out.
All the expenses, yes. It all has to be paid for out of that account. So,
don't max it out.
Yeah, interesting. Good word of caution there.
There's only so much you can put in every year, and that goes back to even our broader concept here, which is funding that account. Like when you buy land, whether it's an LLC or your personal account or an IRA, there has to be enough funding in that account to sustain the monthly expenses that are going to come with it. Once you get past the closing, the expenses continue to roll, right? Like unless you just bought that thing outright in cash and you're only paying taxes and utilities or whatever, like you're going to have a monthly mortgage, you're going to have interest, you're going to have premiums or principals that you have to pay towards, you're going to have taxes you have to pay towards. That fund has to be able to pay for all that stuff. And again, whether it's timber or ag or whatever, somehow you have to fund that account so that long-term it's sustainable. Hopefully it's buying more properties, selling properties, that profit being put in that account, and that builds up to where it funds and pays everything else.
Roger, I'm with you.
Yeah, it's crazy, man.
Well, one thing we haven't talked about yet, just kind of talking about what you just said there, Jeremy, is, not so much related to the self-directed portion is, being able to do this and doing a 1031 exchange. We have not talked about that at all yet.
Right.
And it's a huge part of land. Excuse me. It's a huge part of land investing. Investing in general is just, if you have a property that has some built-in gains and you want to invest and leverage that equity out of those properties, you can do that. You can sell that land tax-free.
Okay.
And to use the equity in there to buy a new piece of property. There are some caveats with that. There's some IRS rules that go with that. Basically, it has to be the same buyer. So if it's you and your wife, if the land is titled in your wife's name or your name, that has to be consistent from property to property. And you have to use a qualified intermediary. So you have to use, contact an attorney or have a separate person who specializes in that.
That makes sense.
So what's going to happen is you're going to sell your property. That money is going to go into your qualified intermediary. You then have 45 days to find a new property to buy from the one that you sold.
Wow.
From that point, once you find and identify that property, you have 180 days to close on that property.
Okay, so there's a 45-day. I got to find basically what, make an accepted offer in that 45 days?
You have to identify the property.
Just identify it.
Just identify the property.
Okay. And then once I identify it and start making the moves to getting an offer accepted, I have now 180 days before closing.
180 days to close on that property.
Okay,
yes.
that makes sense.
And there are there's some prerequisites there, right, Seth? Like there's only certain types of business structures that this would apply to. Maybe let's start there.
Sure. Yeah. So with the tax cut, the tax cuts that happened in 2017, they eliminated any personal property.
No personal property.
You can't, which would be like in our world up here is tractors and combines, and it all has to be real estate. So, real estate to real estate is good to go.
It would include trailers in Pennsylvania.
You can interchange those. It can be from a structured property to a bare land or to farmland.
Gotcha.
It can be real estate to real estate.
What about a private business or rather an individually owned property versus a property that's owned by an entity?
It can be owned by an entity. It does not matter.
Does not matter. Either or.
Either or. As long as it's real estate for real estate. The thing you have to always make sure, though, is that ownership doesn't change, right? So,
yep.
So if it's your entity, whatever your entity is, Joe Blow LLC, has to be the owner of that, the one that you sold, and they have to be owner of the new property. The titling has to be the same name.
Yep. Got it. That makes sense.
So,
and the same would be true. Same would be true if I sell a piece of property that I own personally. I can 1031 exchange into a new piece of property, obviously, that I own personally as well.
That's correct. Yeah. So backing up on that a little bit, the property has to be for investment use or business use.
Can't be your primary residence.
It can't be your primary residence or for personal use. So it can't be a vacant lot that you bought, that you're going to build a house on.
Gotcha.
So it cannot be for personal use. So the couple of things with that is to avoid taxes 100%.
Real quick, Seth, before we get too far down that, where do you draw the line on that? Because, the three of us are buying property that is investment property that we're going to cash rent,
timber,
take timber off of from time to time. And obviously we're going to hunt it. I've got both going on here. Where's the line on that?
Yeah, for me, I guess the way all mine become, I feel like for me personally, all mine are investment.
Yeah, I feel like that too.
Well, but no, I would say it's the same thing.
My history, though, I think for me, my history shows
you're moving properties.
I'm moving properties. I'm kind of, that's kind of how I like to do things. So
I think it's simply looking at let's say I sold my Ohio piece of ground, which is an investment ground. If I want to 1031 that, I can't go buy another Ohio piece of ground with a house on it that I move into.
Sure. That one's obvious because it's personal residence.
Correct.
But this personal use thing is maybe a little more gray. But I agree with you. All of these should be investment tracks. I just thought it was worth asking.
Yeah, no, it's more of what secondary homes. If you have a lake house somewhere, that's personal use. So, I think it's more down that line of personal use where you're really getting a lot of use out of it. Because, how many days are you really hunting out there? More so than others.
Come on, Seth. Yeah. Don't ask that question.
Well, where an interesting piece would be is my Kentucky place, right? I'm at my Kentucky place every other weekend on average, It could be argued that that's a personal use place, but it's owned by my LLC as an investment property.
Mm-hmm.
Right. So, but it also probably has... you probably are generating some sort of income off that.
Yep.
If you have a rent, right away you have rent income coming off that. So
it's not personal use anymore, right? Which is what I'm doing.
Personal use then at that point. It's business use at that point.
Same with my Ohio piece. So I think that's the line is if you're able to do it, and it could be within your own business, right? Like this business is running it from there, it becomes an asset, and that's now where it's categorically laid out.
Sure.
Yeah. The other thing with 1031s you have to be careful of is you have to reinvest the full sale amount.
Okay. Oh, wow. So not just the equity profit that you gain from it.
No, you have to reinvest the full sale amount back into your new property to defer 100% of that gain.
And can that be financed? Seth?
Say that again.
So let's say I sold a property for $500,000. $100,000 of that was my actual gain on it. So now I've got to go back
When
and
you
I've
say
got to
gain, you mean you had 100,000 in equity?
in profit. Yeah, profit equity. Yes.
Okay.
So I bought it for 400. I sold it for 500. So I've got $100,000.
Okay.
I've got to now invest that full 500,000, right, to get the full gain, $100,000 tax-free, piece of it.
And obviously you don't have that money from the sale.
Right. So I've got to finance it, right? That's
correct.
okay.
Yep.
And that can be done.
That's correct. And you're going to have to use this, in essence, in that scenario, you're going to have the same debt.
Yeah.
Right?
That's what I'm saying. You're going to have the same debt as long as because you paid off the mortgage, so you don't have $500,000 anymore. So you're going to have to finance the new purchase of the 1031 exchange anyways. And
really the idea is like, now you have this $100,000 of profit. Now you're going to leverage that $100,000 of equity that you had off
100%.
To, that's the advantage of it is
to buy it down.
100,000.
So, yep. That makes sense.
So,
okay.
So you have to think about that, then reinvesting it. And, some people will say, well, I've had this, I want to draw out like, if there's a lot of gain in it. People like to ask this question a lot, and I'm going to say you can't do it. So
yeah.
But let's say in your scenario, it's $500,000 and your gain is $400,000 and you have equity in it. They're like, well, I have enough equity. Can't I just draw out my equity and borrow more? The
answer is no. Yeah. You've got to put all of that into the pot.
That's correct.
Yeah, and that's an interesting thing because I won't have that much equity, but let's take my Ohio piece of ground, right? I expect to sell that for north of 450, maybe closer to 5 when I eventually sell it. Knowing that I've got to put, let's say, $500,000 in, I've got to buy a big ass property. Like I can't just say, oh, here's another 80 over here. I'd love to buy that. It's only $200,000. I still have to spend $300,000.
Mm-hmm.
So can you do multiple tracks?
Yes. So that's a great question, actually. A lot of people don't know this. So you can have up to three different properties, basically, that you can redo it.
There you go.
That's awesome.
It can be up to 200% of what your initial investment was, more, basically. So, so obviously in that situation, you're gonna have to borrow more money.
Sure. Yeah.
Like that.
But I could go to $1.5 million essentially.
Right.
In total spend across up to 3 properties. Okay.
Right. So, so it can be up to 3 properties and your identifying property at minimum should be at 95%.
Yeah.
Of what you identify. So there are 3 little, doesn't really come into play. Most people that are doing this to expand and grow.
Sure.
Well, Seth, when's the right time then to say, cash in the chips, I guess? Like if let's say I do that once, the next one I do $1 million, right? Now I've got to go spend $1 million out there. And this thing just keeps growing. Eventually you got to say, well, shit, I need to cash the chips in. Like do I really want to have, $2.5 million in properties and assets out there when I'm 50 years old or 60 years old?
Yeah, that's a great question. It kind of just depends, it depends how much you can contribute into your how much of your own personal, we're going back to how do you fund this,
sure.
Right? Can I fund this on my own to maintain all this together?
Right.
The hope is you get enough appreciation off it, or if you end up with multiple properties that you can maybe sell a property to off and kind of keep your main property. So you don't get taxed on it all at that time. You have a built-in gain to a certain property that could be a little bit less than a built-in gain to one of your initial properties.
I gotcha. Okay. So that's where that built-in gain comes in. Because I was going to say, eventually you want to sell some of these pieces and you don't want to be like, sitting there looking at $150,000 tax bill or something like that.
Ideally not, no. Ideally not, but
yeah.
Well,
it could happen. Ideally, I think for a long-term investor, I think the 1031 exchange really works. So,
yes.
It really works, but then it comes down to, are you going to keep these forever? What is your end goal? And, then you probably bring in a whole nother conversation of that's when you kind of start doing some estate planning, things like that.
I was going to say that seems like a strategy. So hypothetically, right, let's just use my Kentucky piece because that in my mind is my forever home, right? Eventually I move to this place. It becomes more of a personal place than a renting place type of thing. Anyways, if I roll and continue to expand and buy properties around that area, eventually I hold on to those and they then just get passed on to my kids as part of my estate, right? Versus an investment strategy of cashing out and buying other things, or, you know, using that money elsewhere.
Yeah. Which may be different if you didn't have kids.
Correct. Yeah. So, you know, I think that at some point there's an end game, whether it's death and estate pass downs, or it's selling pieces off and using that money to, you know, buy a second home in the Florida Keys or wherever the hell you want to be.
Yeah.
I think it's interesting. And again, I know that there are people listening to this and say, well, you know, this is completely irrelevant to me. It doesn't have to be, especially if you're looking to buy 40 acres somewhere. Like, that is the start. You know, it was 60 some for you, Seth. You know, that is what gets this ball rolling. And again, I'm not saying don't focus on your finances and what you can afford, but surely don't think of, okay, I bought 40 acres. I'm going to pay this thing off in 10 years. Cool. Then what? You know, what's next? You know, are you just happy with that, or do you want to continue to build wealth for you and your family? And I think that you have to look at each of these assets as a stepping stone to your overall wealth. And if you can do that, you know, nobody's saying that you can't start building this, you know, land wealth platform. Empire. Yeah. I like it.
You would have told me 10 years ago I would have ever done any of this, I would have called you a stone-faced liar. You know?
Yeah.
So, I mean, it just kind of, you know, life comes at you fast sometimes, you know? It happens, and you just kind of flow with it and go with the punches. And, you know, at some point, like, I'm going to be done here. Like I said, for me personally, our neighbor that had passed away, he did pass away, and I have entered into a purchase contract for his ground when his estate clears. Gotcha. I have not purchased it yet. So when his estate clears, then I'm going to be done probably, you know. Yeah. I'm maxed out. I don't want to afford anymore, you know.
Well, and I guess that's where I was kind of getting at, Seth, is at some point there's you're done. You know, you got enough. Like, I mean, hell, we run into it all the time, especially as hunters. Like, we think like, oh, give me more and more land. Eventually, there's too much. You can't hunt it all. Right, you don't have enough time to hunt it all.
Dude, it's all this stuff. Even like the cash in your bank. Like, you can only spend so much money. Like, until you're like, what? You know,
what are you buying?
And then you can only own so much land or so many assets, and it's like you can only have so much wealth. And at some point, it's like, what do you want to do with your life?
Yeah, and I think that it's I think the whole goal here is you create a process that not only builds wealth for you long term, but allows you today to enjoy it. To go and walk out on that property and call a turkey off the roost, or in 6 months to sling an arrow through a mature buck's heart. Like, it allows you to do things and have things and tangibly enjoy land ownership and nature now, and has long-lasting benefits to when you are ready to hang it up and cash in the chips to set you in a really good situation, or your family in a really good situation.
Well, I mean, that's the biggest argument for you know, investing in land over, you know, any of these traditional paper investments we've talked about, is instead of waiting to enjoy that when you retire, you know, start enjoying it now and building wealth along the way. Mm-hmm. Yeah. And I think we've subscribed to that for sure.
Yeah. And you do have to have money, right? I mean, ultimately you have to be able to start this ball with likely a 20% down payment.
Some really good things have come out of this
mortgage.
Podcast. Yeah. Regarding that.
Yeah. I think it's great. But once you get to Seth's position, you now, and I'm nearing it. I don't know how. I haven't done it yet. I'll probably call Seth, but like, I've got multiple investment properties that I put 20% down on each. I've had one for 3 years now. The other one I've only had for 4 or 5 months, but I've got equity in two really nice farms, significant equity. And so if something else comes up, it's like, well, I don't have 20% that I want to put down. How do I leverage my equity in the places I have to buy that one? Because I probably can't afford the monthly. I just can't put out another 80 grand or 100 grand on a down payment.
Yeah.
And so that's where this thing gets really interesting.
Well, that's the beauty, too, of like the momentum of these things, is a lot of these properties do seem to be able to sustain the monthly payments as long as you can come up, and it starts with one, you know, so if you buy $100,000 property and you come up with 20 grand, eventually you can leverage that asset for the next down payment on the next property.
And you don't have to spend the money, meaning you can put that in the account to pay the mortgages.
Each of those properties individually, if you're smart about your investment, should be able to meet their own monthly payments.
Whether it's ag, like Seth is saying, it's timber, like we're investing in, or structures, which I have, and rental income. And I agree with Seth, because I have several tenants. Like, they're great tenants, but it's also like a headache that I wish I didn't have.
Yeah.
There is rental, or there is income sources on these properties. Some of them one time, like a timber, some of them monthly, like a rental income. But you can bring in revenue from these places that, it may not cover your mortgage, but that one-time timber cut could put 50 grand in that account, and that might pay mortgage on multiple properties for 2-3 years.
Yeah. And you always have options with assets too. I mean, you hate to hear it as a hunter, the idea of like leasing your land to somebody or but there's always options. When you have an asset
100%.
like that, there's ways to make money off of it. And ultimately, you own it. So.
Yeah. Yeah, absolutely. Like I said, go plant ginseng in your timber. Go, go plant an orchard, go do whatever you want to do. So have control over it, have fun with it. So it's pretty cool. I was turkey hunting with my daughter last weekend, and she was sitting there and she's like, basically it's like, I can't wait to take my kids out here hunting someday, Dad. I'm like, cool. Like, perfect.
Yeah, how
like,
cool
that's
is
all I
that?
need to know.
Sorry, honey, I sold it last week. No,
that one was not sold.
This one's actually owned by Daddy's self-directed, so we don't tell anybody about this.
It is awesome, man.
No.
When you see it, because I didn't have that. I hunted on permission properties. I didn't have that privilege as a kid. So now that my kids are able to walk out they're going to Ohio for the first time on Sunday, I think. I'll be like, guys, like, this is your 130-acre farm. Like, this, do what you want. You want to find arrowheads? Great. Want to go kill turkey? Great. Want to put a camera up? Awesome. Like, and it's, it's a powerful thing for me because I didn't have that as a kid. So now being able to try to get them to understand, like, this is something else. And they're young, right? They don't understand wealth and how this works, but eventually they will. And I think it's something to really look at and appreciate, whether you're, 29 or 38, like, ultimately, like, that's a future investment for you, for your family, for your enjoyment now. So, well, Seth, anything we didn't cover that you wanted to before we let you off the hook here?
I was just kind of looking over it because I took a few things, just some highlights and stuff that we wanted to talk about. And it looks like we covered, we didn't go into depth as much and probably don't need to. I think the one thing I would stress with everyone is with these things, there are going to be fees and along with these investments, and just the fees are okay. You have fees, internal fees inside your paper accounts. So be okay with these fees. Use a tax professional in your state.
Yes.
Because the state laws change so much. I mean, I can give you guys federal advice. I can give you generic, probably Pennsylvania advice that I can look up, but find someone local who knows it, and, really use resources like that. And, don't be afraid of it, I think, just to kind of embrace it and go with it. And also, people also look at this investing a little bit different too. I look at it a little bit different, I should say, is the fact that people are always easy to put money into, a joint brokerage account or a joint, your IRA accounts. Well, think about your debt payment as your investment in your joint brokerage account, in your Charles Schwab account or whoever you use.
I know.
So, it's people do that. And a lot of people do that. And think of it the same way because it's still an investment and it's still an asset. So,
no, I think that's great advice. I think it is something that the down payment scares people because it's a large chunk, and typically they're only used to doing that when they buy their primary residence, which they use every day, for X hours a day. I think as it gets into understanding how mortgages work and those payments are coming through, you have to be confident in your financial situation to know that you can make those payments on this other property. Because odds are you're not going to get enough income out of that thing out of the gate to pay that mortgage, all the time. So you're going to have to fund it. But I think that the moment you can fund it and say, okay, I can sustain it for X years as long as nothing changes, then you're in a good spot. But don't stop there. Now think about, well, can I cut timber off of this? Can I cash rent it? Can I CRP it? Like, what are the opportunities here to help aid this account that is now funding those monthly payments and those monthly expenses? And eventually you'll get to the situation where, hopefully you've sold one and that's now become the funding source, and you've bought another one and you've got this, and, it just snowballs from there. But the biggest thing that I would say for people listening to this thing is, whether you're looking for your first one or your 10th one, don't outpunt your coverage. There's nothing worse than financial stress, especially if you're in a really good position right now, and then you go and buy something that you truly can't afford, and you put yourself in that financial stress. It was for no gain, literally. And the last thing you want to have to do, even in this market, is try to dump a property because you're in a bad situation. It takes a long time to get through a closing and make sure all things go right. So, just make sure that
it just takes all the joy out of that investment you just made there.
And for the three of us, because I know it's important, communicate with your spouse as well. Like I told my spouse the other day, I'm dropping a $11,000 HVAC unit in this cabin in Ohio, and she about lost her mind. And I said, listen,
I already did it.
I did. I signed the paperwork already. But here's why, and here's what I think the value will be when we sell this place, because it will be the parcel or the residence for this parcel, right? That farmhouse won't exist anymore in this parcel. It'll be segmented out. It starts to make sense, not only for the next 6-7 years of us using it, but for when I sell it, the resale value in it. And so you just, open communication is key. You should have those discussions, because
to which she responded, great. So what you're telling me is you make the investments, I make the sandwiches. Got it.
So, but yeah, those are my 2 cents. But yeah, I if you can only afford 40 now, don't go buy 80.
Yeah. Well, dude, and for people, I think in my age bracket and even younger, coming out of college and stuff, one of the hurdles in terms of like wealth that we've talked about, I think is broadening your mindset to understand that like assets are a form of wealth, not just an expense that takes money out of your bank account. Mm-hmm. It was a natural progression for me because I enjoy land and I'm familiar with, its elements of value. But to somebody who's just, way more comfortable with, their bank account, the levels of these accounts, or even investing in, different paper investments and stuff like that. This is just it's a different way to go.
Yep.
And, but it is a very relevant source of wealth that, should be treated as
wealth
such.
isn't always cash.
Yeah.
Cash is king. You need it, but
you can only use so much of it though. At some point you need to look at turning cash money into vehicles for wealth.
Plenty of people who probably are sitting on a lot of cash and don't have a lot of happiness.
Yeah.
So that's the way I look at it. Yeah. Not me. I have, I've got assets.
Yeah.
So
yeah, it's got assets and I'm depressed.
Yeah. I've got enough cash. That's it. I'm not loads of cash. So.
Cool. Well,
yeah.
This has been awesome, Seth. And I want full disclosure to our listeners too. So Seth actually reached out to us. Was listening to some of our HUNTR podcasts, and I don't know if you came across I Bought a Farm here at some point, but reached out to us on the website and kind of gave us your credentials and stuff. And I apologize, as I did before, it's taken us a little while to come full circle to you, but man, Jeremy and I both really appreciate the insight that you bring, to the tax, to the, land investment side of all of this.
Experience. I mean, there's nothing that even can replace that. And the fact that like you're actively doing this stuff, I mean, that's how you learn how this all works.
100%. So
yeah, I appreciate the opportunity to come on, and we talked more about what I went through more than I realized we were, than some of the tax stuff, but tax stuff you can kind of figure out on your own. So yeah, if you guys have any other questions, let me know. Or you guys gonna ever head out to Iowa?
We're planning on
it.
Draw a tag sometime.
What did we get our third point this year?
Fourth.
Yeah, we got our fourth point this year. Either way, Seth, we'll obviously stay in touch, and we'd love to have you on the podcast again in the future.
Yeah, for sure.
Jeremy and I are kind of going through this in real time, and so I'm sure we'll have
I'll have some learning experience, I'm sure, from the whole self-directed here in the not too distant future.
Yep. And so I like to let Jeremy go first, and I learn from his mistakes. So
I like to plow the road.
The best education you can ever make in life, right? It's just making mistakes, learn from them.
I know it, man.
So
and the best place to view them from is when your friends doing it for you.
Yeah, exactly right.
I will say that I because I hear this a lot. There are definitely bad purchases, but I don't think it's due to the land or the property as much as it is you weren't financially secure enough.
Of your own cash flow.
Yeah. Again, and Bill Winky, I think, was the one that said, like, you want to get that property for the right price. The only way you're going to do that is buy it now, freeze the price, and then wait until the appreciation catches up if you think you overpaid. And I think that's still probably one of the things that rings true to me is that, we're all looking for deals out there, but ultimately they're not making any more land. It's going to continue to appreciate in value. Some areas more than others, maybe we're not all paying $25,000 plus an acre, but like it is out there that, if you want to get into the game, now's the time if you're financially secure enough to do it.
I would agree.
Perfect,
Cool.
man. Well, awesome, Seth. We appreciate it, brother. Thanks for coming on. Sorry for the delay this morning. Took the April snowstorm had me coming off the mountain a little bit slow, but yeah, I'm tired of winter again already. So we appreciate you taking some time here after your tax season. You're probably ready for a breather.
We're getting there. You bet. Another month or so. So yeah. Appreciate it, guys.
Right on, man.
All right,
We'll
thank
talk
you,
soon.
brother.
Yep. We'll see you.
Yeah, man.
So again, it's cool because he's a tax professional, but it's cooler to me in that he is actively doing it. It's one thing just to know, like, here's the rules, here's the regulations, but you got to know how to apply them in a practical sense, which he has, and he's moved and sold a lot of properties, and so I think that as you kind of hear it, and it's good, like when we're talking through it and he's like, yes, that makes sense. This makes sense. You're like, okay, I think I'm on the right track here. I'm getting it. Like, it makes sense. But, again, wealth of knowledge and can't encourage it enough in that, a lot of people I think can think about wealth and can really get into this wealth side of things, but you can't do it if you extend beyond your means. And so, start planning now. Even if you can't afford it now, like he said, you could start saving for the next 6 months and be like, wow, I put aside $10,000 that I didn't need, Those are the things that start to get you in the right direction and in terms of being able to purchase land as an investment. But you can't just say, well, yeah, I think I can afford it and go out there, because even once the closing's done, there are monthly fees and taxes and mortgages and things that need paid. And if you don't have the money for it, it's going to put you in a bind.
Yeah. All of these things we're talking about are ongoing. I mean, dude, I just think in life, and generally speaking, like, so few successes come from like one output of effort. And it's like, okay, I'm done. This is very much, I think, like the culmination of like a lifestyle or a career of building funds to be able to step into, this is essentially a level of investment or of money making or of wealth generation. Like, it's not like, I think a lot of people look at land ownership as like a pinnacle. At the end of the day, I want to buy one piece of ground and that's it. And I think that's admirable. It's just the idea of land ownership that's a healthy thing. But
and what is that? Is it you're going to buy a piece of ground, you're going to pay it in full, and you're going to own it? Because what's at the end of that? Like, versus I want to own a piece of ground. Like, even though I don't 100%, the bank has a mortgage against all my properties. Right? I own that ground. I can do whatever I want on it, and I eventually will sell it and hopefully make money on that thing. Yeah, that's my goal.
Well, I think it's a balanced approach. Like, while yes, we should probably always be considering at the when this property is, we have this much equity, or when this opportunity arises. But in the meantime, and this is the lifestyle I'm talking about, is like find a way to like maximize your enjoyment of just the process of owning this piece of property for a short period of time or a long period of time.
Who knows, man? I mean, there's places I could get a call tomorrow from a neighbor who says, "Hey, I've been thinking about it. I can't believe you got that property. I want to buy it from you. I'll pay $80,000 more than you paid for it. Take it."
Done. Things happen. So
next up.
Yeah, I think that's just, as much as we talk about like
the attachment piece of land ownership is, I think, the harder piece. We didn't discuss it as much, and it sounds like Seth does a great job at it. I'm terrible at it. Because the moment I step foot on a piece of property, I'm like, I love this place.
Well, dude, the first time you and I walked properties together, not even properties that we're buying or anything, like it's a lease or it's a piece of public, like you're always like, this is the best piece of property I've ever seen. Yeah. And because to counterset that, I have to be like the extreme pessimist. I'm like, well, yeah,
Yeah.
it is what it is.
It's just because I love land.
And it's
Like,
always
I
somewhere
love
in
land.
between. It's never as good as you think it is, but it's always a little bit better than I think it is.
It's never. Like, I walked my Ohio piece the other day, and I'm like, there must be 100 deer on this thing, and there's not. But I just I love this place.
Yeah.
And meanwhile, my wife's like, you're gonna sell it, right? And I'm like, yes.
Yeah. Well,
Someday.
see, your payoff is in the beginning. Your excitement's at an all-time high. Mine is somewhere towards the end, because it's usually a little better than I hoped.
Yeah. It is. It's just an interesting thing. Like, my Kentucky place it's cool. It's not that great of a hunting place. Like, I've got some good deer on it. I've got some turkeys on it. But where it sits in proportion to a lake and like having just access to like land and a really nice cabin, like, yeah, it's just a great piece of ground. Would I say that it's a great hunting place? No, by no means. Yeah. But that's not what I bought it for.
Sure.
So I think, to your point, when you talk about like the clear cuts and stuff, if you're looking for like just, I want a nasty thick like hunting piece, yeah, buy that. Yeah. That's not what I was looking for in either of my first two purchases. That doesn't mean the next one I buy isn't just a gnarly thick 40 acres in the middle of ag country that has big bucks. Like, maybe it is.
Well, it's just, there's a market for different things. And while there's always, I don't know about always, but like there's definitely a market that exists for people looking for a getaway home, in the Kentucky hills, and maybe have no interest in whitetail hunting.
Sure.
That property is going to be very, very catered to. Yeah. Whereas there may be another property that is a clear cut and, maybe isn't as like attractive or in a location.
Aesthetically.
Yeah, but you might be able to kill a booner there every year. And undoubtedly there's a market for that too.
Huge market. I think the biggest thing that people, and I say this because I'm at the outer edge of where I'm at and now working back, is make sure if you are buying a place that you're going to be able to get to it. It sounds logical, but there's plenty of people I know that own ground in Kansas and live in Ohio, and they get there maybe once a year.
Yeah.
I don't think that unless that thing is income generating, I don't think that's the right way to do it. I own a cabin in Kentucky that's 5 hours. My Ohio place is 3 hours. Those are like the outer range to where I know that I'll use those properties, and mainly because they have a structure on them that I can stay at.
Well, and we can probably share our, you and I both own businesses that occupy 60-80% or 60 to 80 hours a week. I don't know.
A lot.
I don't try to keep track, but just generally speaking, we're very busy.
Yeah.
But we also prioritize, during specific times of the year, our
to make sure we get out,
to make sure we hunt. It seems like it's realistic to plan on 2 trips a year.
Yeah, we've tried to do more. It's not realistic.
Yeah, like one early, one mid to late rut, and then in between have a home farm.
Well, and I think that people, I've seen a lot of people have buyer's remorse because they buy a farm, they don't get to it, and then they're just in their mind, they're hemorrhaging money. It's still an asset that they have value and they could sell, but because you're not using it, you're losing that portion of the attractiveness of land investment.
Well, it's like us buying land in Iowa. It's like, what sense would that make?
None.
We can hunt it every 6 years.
None.
Or every 3 on a muzzleloader tag or something.
Yeah, none. So I think that those are the things to keep in mind. And in the same breath, understand where you live right now, and it may not be feasible. I know you're looking, but it's tough to find land within a half-hour drive or 45-minute drive of your house, your primary residence. Yeah. None of my properties are within that. One's 3, one's 5.
Well, and dude, from a deer hunting standpoint, I'll tell you what kills deer is observation. And so
100%.
whether it's loaded with cell cameras or better yet, you live on the place and you drive down the road every other day. That's how you kill big deer.
That's how Bill killed a lot
live
on his properties.
100%.
He lived on it.
Dude, it's observation. They're just animals living in the woods. It's like, hey, you see them, you set up on them, you kill them.
Yeah,
tough to do from
cell
states away.
cameras have changed that a ton.
Yeah,
a ton,
no doubt.
But there's still something to be said for just eyeballs on the property. But yeah, it's really tough. I mean, a lot of people say like, I want to have a property close to my house. Realistically, that may not be what you want. I mean, look at Seth. They're paying $25,000 an acre around his house. He's not going to buy stuff down there. That's why he's buying it 3 hours south.
Well, it's also not the best deer hunting ground where he's at.
It's ag ground.
It might be better than, other places, but it's not as good as southern Iowa.
It's ag production ground.
Yep.
So, yeah, just keep that in mind. But anyways, we hope you enjoyed this episode of I Bought a Farm, episode 4. And, 4. And yeah, we'll see you in 2 weeks.
Later.
If you enjoyed listening to this episode of the I Bought a Farm podcast, make sure you check it out every other Thursday night on Apple Podcasts, Spotify, Google Podcasts, YouTube, and any other place that you might find your favorite podcast.